All right, I think I'm live. I think I'm live. All right.
Been a pretty
All right, what up, everyone? I am live. I'm live. I'm live. Okay, cool. What up, everyone? Welcome back to Financial Education and Business. So, we're going to be reacting to what Amit is going to be talking about in this video, and then we're going to go and look at the companies that are going to be reporting earnings this week. Um, I guess big tech is starting their earnings, and so let's see what happens. We're expecting obviously decent numbers if the economy is actually keeping up, or if it's all just inflated due to the whole AI industry. So, um, earnings guru. So let's just look at the companies that are earning. Well, let's go public company, public company earning calendar. There's a couple of actually really awesome sites and Financial Inc. We'll go with not Yahoo. It's not really that good. Not Investopedia. Let's go with analysis. Stock analysis. I think does a decent chart. Not the best chart actually. Um, let's see what they have. Mm, let's actually just look it up here. Uh, earnings report. Wow. Mm, mm, mm. Earnings hub. So this guy, I believe, has a decent site here. He talks about the earnings that are going on. So boom, 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 the earnings calendar. Calendar. All right, this is what I wanted to see. So earnings this week. So the 21st, obviously today we had Netflix. They reported earnings. Their earnings looked pretty bad actually. Their stock went down by a little bit. It got beat down. Let me go here. I'll pull up the stock as well, and we will look at earnings from Netflix and other companies. So let me just log into Earnings Hub. Mm, Continue profile. No. All right. Cool. So let me go to earnings calendar one more time. Earnings calendar. Boom. There we go. So big tech earnings just started. Obviously, we have some of the biggest tech companies that are going to be reporting this week officially. Who do we have? Well, before market open tomorrow, actually today, the 21st, Coca-Cola. They reported earnings. I didn't see where their stock went, but it looks like they're down a little bit here. Overall, I think during the day they went up about 4%, which means their earnings were pretty good. It looks like from a revenue perspective, they were able to perform just fine. EPS looks like they reported and they beat EPS as well. Um, Revenue and EPS both beat. So the revenue beat by about 0.3%, and EPS was beat by 5%, which is pretty decent. which kind of goes up. Obviously, Coca-Cola is not a tech company, but kind of says that consumers are still buying stuff. Lockheed Martin reported today as well. GE. GE is an important metric to look at because right now, well, let's see. The revenue beat by 14 and EPS beat by about 13, by 17. Revenue 17 and EPS by about 13%. This kind of tells you a lot actually. When companies are like GE's beating earnings, you got to consider, well, people are out here, buying homes, renovating homes, or uh, buying home appliances. This is usually what happens when big companies are when companies like this are reporting earnings. It kind of tells you what's going on in the underlying economy. um, so it's oops, I guess I need premium. But it's good to see that you're noticing GE selling products here, which kind of highlights what's going on in the aerospace report. GE Aerospace reported 26% increased revenue year over year, about 11 billion, with corresponding 26 raise in operation profit. Nice. All right, let's go on to RTX, Raytheon, 3M. They all reported. GM, Nasdaq. I thought that I wait. I can't click on it. Okay, can't click on Nasdaq. Kind of weird. After close, we saw a Netflix report today. These numbers were not good at all on Netflix. The stock obviously took a hit. Netflix. I think they were down about 6%, 4%, 6%, 6.5%. Um, After hours, they closed about 0.2% on the day, but overall down about 6.5%. The problem with Netflix is I think Elon kind of beat them up a little bit. There was a whole Twitter thing that was going on, saying people shouldn't be subscribed to. People shouldn't be subscribed to them. That they're kind of doing bad thing to bad videos for kids, that are kind of more of molding the minds of kids rather than actually being an entertainment feature, which I mean, almost every media is that way, kind of, it molds people in a specific direction. Obviously, the company has, their own corporate beliefs and trajectory they want to go or take the company. So, anyways, Elon was kind of beating them up for the past couple of, at least for a good month. A whole bunch of people are unsubscribing. Um, and due to that, it looks like they got beat up a little bit. Their stock went down by about 6.5%. Historical. Let's see what they did on their financials. Um, Statistics, forecast. So, so overall, looks like the the analysts are forecasting the stock to be 1600 at the highest, low of 875. There's talks actually where Netflix could buy Warm Bros or something like that. Let me look up something. Netflix to buy Warren Brothers. So there's talks where Netflix could buy Warren Brothers, which they are for sale. And the only problem with Netflix getting, trying to buy that company is they're a little too big. Netflix, Comcast, eyeing possible Warner Bros. Sale. There's a lot of really good brands under Warner Bros. Let me see if I can find all the Warner Bros. Products, brands. So there are a lot of brands that this will bring to the Netflix ecosystem, which Netflix doesn't have ownership of right now. But if they do, I think this could be a really good win for Netflix. But it is a little bit expensive for Netflix. I believe the it was for sale in the $100 billion, I believe. But they'll get DC, Game of Thrones, cartoons, Harry Potter, Middle Earth, which is an amazing show. Um, Scooby Doo, Tom and Jerry. So they have decent brands. So I mean, if Netflix does make that buy, it's gonna bring it. It's gonna make their ecosystem even larger. Uh, Texas Instruments, not too crazy. T-Mobile, GE, uh, none of these. Tesla is also going to be a big number here. Obviously, they're expanding with the robots. They're expanding with their as well as the robots and the autonomous driving capabilities. So that's going to be an important thing to look at when Tesla reports how they plan to how they are going to plan on introducing these autonomous driving cars. If they have expanded, if they have more partnerships, these numbers are going to be really important for Tesla. Obviously, it's a huge market cap right now. SAP is also reporting. This, I guess, on Thursday, the 23rd. T-Mobile, Blackstone, Honeywell, Intel. Obviously, United States has about 10% stake in Intel. Ford. Ford is going to be interesting to see, as Trump has moved a lot of the supply chain and production of a lot of cars into the United States. So we're going to see how they're handling that expense, because they can't really buy stuff from China anymore. Uh, Procter and Gamble is going to show consumer sentiment if people are still buying their products. Obviously, Procter and Gamble makes a whole bunch of different um, home items and baby care products. So let's get into what Amit has to say, and then we'll go from there. Amit is going to give just a summary for the day, and let's get to it.
Pretty crazy 2 days as we start off this week in the stock market. We officially have big tech earnings that began today. Netflix, we'll talk about Netflix results, down 5% after hours. Wasn't the best earnings, wasn't the worst earnings, but we'll talk about that. Amazon, Google, and OpenAI, all three of them, tons of different announcements today. We'll talk about those. Trump made some more comments on China. As always, hopefully this negotiations will be starting soon, which we'll be discussing as we get into the end of October. And then the other main thing that we got to talk about today is gold. Gold is going down, lost its worst amount of market cap, 1.75 trillion with a T, since April 2013. At the same time, the S&P 500 basically all-time highs. Dow Jones was like $40 away from all-time highs, and a lot of the Oklos and quantum stocks and nuclear names and drone stocks and big bear AIs took a hit today. We got to talk about what's going on with the broader market, what's going on with commodities, and what's going on with these momentum plays that might be losing some momentum.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44.
I think the main momentum plays right now that are gonna take a big hit are probably a lot of the companies around the what do you say? Let me pull them up actually. Yahoo Finance. So it's gonna be a lot of the quantum companies, as well as a company like Oklo. Like, it doesn't make sense why Oklo is up 200%, and this company doesn't even have a product. All they have is just a word of, oh well, we're going to be able to build nuclear plants, holding. We're going to be able to build, nuclear plant in this location, but it's going to be in 2027. So imagine paying for a company that doesn't even make any revenue until 2027, and their stock is up 500%. That's insane. So I think there's some, what's the word, froth in the market. There's a lot of people that are just buying for an opportunity that the company will execute on their plan. But often we know, things change. Between now and 2027, we could have a recession, and everything we know about Oklo could just falter. So Oklo, so this company here, doesn't even have a product. This is how you see there's froth, and in a good way, the froth is kind of getting removed from the market. So, and it's getting, the froth is kind of getting beat up. So you see this company here, year to date, they're up 556%. And this is a company that hasn't produced any products, and all of it is just for hopes of one day they will do that. And this is never a good sign at all. This is how you know there's too much froth, and the companies are, and people are just buying stocks for the sake that it will just keep going up. And it's that's been the case. Oklo has been able to continuously go up, and people sometimes don't see, oh well, it's going up, so I'm going to buy it, but they don't see the underlying company performance of revenues or operating expenses, or if they have any products at all. So Oklo is a US-based company pioneering advanced nuclear engine solutions with a strategic focus on powering the artificial intelligence ecosystem. So Oklo is positioned at the intersection of nuclear energy and AI. Like all these, like these are all just like words. Like they don't make any revenue. So the market cap of the companies, at least this says 21 billion. Let's just double check. Thought it was a little bit more than that. Yeah, it's about 21. So it's $21 billion market cap. Year to date return of about 600%. 3-year return 1300%. An EPS of negative 38. Revenue 0. Despite being a pre-revenue, Oklo has attracted significant investor interest due to this potential to solve the energy bottleneck in AI infrastructure. But the problem with this is there's already companies out there that produce energy, that actually make revenue, and actually have customers. And so this doesn't make sense where we're talking about a company like Oklo that doesn't even have revenue. It's in the last 3 years, it's up 1,300%. So that's my biggest, just that's what kind of worries me, that there's a lot of froth in the market, and the market needs to kind of settle. The fact that it is up 525% in 1 year, it is up 556% year to date, for about 557%, and past 6 months 583%. Like that is insane for a company that does not make any revenue and just actually kind of broke ground. So in a way, this seems very much of like I hate to say it, but seems like a Ponzi to me. Maybe in the future they'll do something. There's potential there, but right now there's definitely nothing. So looking at the market here, we are seeing companies around these quantum companies that have just been killing it, doing an amazing job. But at the end of the day, these companies are up significantly, and the need for quantum is still years away. And there's no potential use case right now that really like AI can't solve. So now quantum is also getting beat up. As you can see, year to date, 42%. 1 year, they're up 300%. And why? What change that quantum now should receive a valuation like this? That in 1 year, this company here can have a 300% gain. I so yeah, that's my biggest worry is like I'm kind of speechless because these companies are pre-revenue and they don't have anything that they could provide right now for the economy. Maybe in the future, I think quantum will be important, but like we're nowhere close to that. And if I'm thinking about getting into quantum and a quantum company, I'm not gonna buy IonQ and all of them. I'm gonna look at a company like Google, who has been building out quantum computers working on quantum computer for a long time. They have the ability to use AI already to build out these quantum infrastructures. The money, the investment, the knowledge, they can actually pay their employees to people to actually develop quantum computers. So what is the need? So to me, the valuation for these quantum companies is way overblown. Um, so anyways, so we're seeing some froth just kind of get removed from the market. So it's always a good idea when this happens, just because when froth is removed from the market, then you actually see real value, real money come into the market and actually push the entire market even higher than it is right now. So being this close to an all-time high, I think it is a good idea to start just kicking out all these terrible businesses, and focusing on the ones that actually create true value, and investors are obviously going to rotate into those types of companies. Um, from a and then from a gold and silver, uh, gold and silver are taking a hit right now. Let me see if I can find. So gold and silver are getting hit. Today, gold was down about 5%, silver down about 7%. The rotation has started. Obviously, we were talking about silver and gold the other day, talking about how it's overpriced. It doesn't make sense to where it is. I also explained how this is probably some kind of rotation in the market. Um, a rotation in the market where the market in gold and silver goes up and quickly rotates to other products. So gold, let's look at launch chart. There it is. So we're seeing a rotation in gold. Obviously really got beat up today. If we look at the market, and we were looking at it at 4200 here, and all day today it was just getting beat up. And we talked about all those people online trying to buy gold. Imagine you're buying gold here, and now like a day later you're down 7% on that gold bar. And obviously this movement that we're seeing in gold is not done. It's not done by some Joe Schmo that's buying gold. No, it's done by institutions in countries that are buying gold. It's done by China that's trying to standardize its currency, trying to be competitive against the dollar, um, and trying to create a new standard under gold, and trying to kind of devalue the U.S. dollar. So obviously this is more of a larger economic battle, and it's not just like your neighborhood family that's buying gold that's moving this price. But maybe we see gold continue to go up and it's just testing this area. But overall, I don't think gold should be sitting at 45, 44, 100 an ounce. So we're seeing rotation on gold, we're seeing rotation in silver, which is a good sign, because what's going on? We saw when gold sold off today, cryptocurrencies went up. So if we look at coin market cap, we're gonna notice that um, we're gonna see it. Yeah, there you go. So if you look at coin market cap, we're seeing rotation here. Bitcoin is back in the 108. ETH is going back up. It's in the almost 4,000. Almost hit 4,000 today. I believe that's what's gonna happen. We're gonna see this value in gold, which has already happened. People are gonna sell, and they're gonna rotate to the next asset, which is maybe probably the stock market and the cryptocurrencies, because that is what took one of the biggest hits in the economy recently. So let's go on.
Let's get into it. Okay, so let's get started with what's going on in the broader market in regards to some of these momentum stocks, because I think it is very, very important to talk about this. So over the past week, Oklo is down 10%, D-Wave down 27, Big Bear down 21, Rigetti down 27, IONQ down 29, SMR down 14, Nano Nuclear down 22, MP and USAR, rare earth companies, MP is down 25%. USAR is down 20%. There's a lot of other names on that list. Ondas down 30%. We can go through a variety of different names that have essentially picked up tons of momentum over the past couple of weeks, really the past couple of months. They're all getting hit. Now, here's the question, and then I want to get to my opinion on kind of what's happening right here. I would love to know what people think in the comments. Do you think the decline we're seeing in some of these names that don't really have the most earnings potential, revenue potential, I mean, they're not really showing anything other than the narrative. Big Bear AI is guiding to negative, let me say that again, negative 5% growth in the sector where companies are growing over 50%, which is AI. So you've got companies that have AI in their ticker that cannot grow at all. They're negative growing this year, that are up 80% year to date. A lot of these companies are not the worst companies in the world, but they are companies that have been essentially cultivated by a narrative. That narrative has not resulted in any meaningful earnings growth, any meaningful revenue growth. But those stocks, if you look at all of them, a lot of them are up 4 to 5x year to date. I mean, it is quite incredible. My question to everyone here is, do you think the momentum that is dying out objectively, which, so far we've seen no real reversal of that momentum coming back, is that a structural momentum decline in these stocks, or are they taking a breather? My take on this is that I don't know, and I don't think anyone can really know. We're all just guessing here in terms of what's or how this is playing out. But if you have to look at some of the data that we're getting, it does feel like they're losing more momentum than not. And the reason they're losing momentum is because, simply put, they've gone up a lot and people want to take some profits. And when you have a stock that goes up a lot, like an NVIDIA, and it can, keep putting up earnings growth, you might have people that might not want to take some profits. I've not sold a single share of NVIDIA all year. My average is 122, stocks at 180. I'm up 50%, but I don't want to sell because I think NVIDIA can continue the earnings growth. For a lot of these names, if you bought it off the idea that, well, Oklo is going to be big because it's nuclear energy and we need nuclear energy, there's nothing really holding you into the narrative outside of that one sentence. There's no earnings, there's no revenue, there's not any of these massive deals, and there have deals in the pipeline, but it's not manifesting in anything you can tangibly say is actually helping the company.
Build a website you love with Wix, where your words
right now. Same thing with a lot of the quantum names. And again, this is not being bearish or skeptical of all these different companies that are out there. I don't have positions in them. I don't have shorts on them. I don't have puts on them. It's not to say that. It's rather saying, hey, for the health of this bull market, can we figure out, do these names have the validity, the legitimacy to keep going higher? And the thing about momentum is that when momentum dies, we were talking about this last week, it's really hard to get it back. The only way you get it back is if you put up good earnings growth. Palantir and Robinhood were momentum stocks back in 23, 24. They would not have had the 2025 they had if those companies did not put up the gigantic earnings growth, both of them over 50%, that they did in the past 9 months. And so you can disagree with Palantir's multiple, you can disagree with Hood's multiple, you can disagree with freaking Apple's multiple. Apple trading at 35 times earnings, growing like 5% a year. You can't say they don't deserve a multiple because they are growing and they are buying back stock, Apple with 100 billion, and they are quality companies that are putting out products and services in the world that really do matter, aka they have a moat. A lot of these other stocks don't really have a moat, don't really have earnings. A lot of them don't have revenue. They essentially got bid up in the span of over, basically, call it 2 months. I know year to date they've done very well, but over the past 2 months, that's where they really got the bid. And that bid might be fading. And so I think it's important for all of us to just understand what is happening right now. The S&P 500 is $2 away from all-time highs. A lot of these stocks that were up 30 to 40% when the S&P 500 was at all-time highs 2 weeks ago are down 30 to 40%. But the S&P 500 is barely down 1%. NVIDIA back to 180. I mean, yes, it's down from 195 to 180, but NVIDIA is not collapsed. Palantir is not collapsed. Robinhood's not collapsed. Yes, down from 150 to 130, but Palantir's Hood's up from 97 to 130 after S&P inclusion. I think that's a pretty big run for Robinhood, but did it deserve 150? Probably not. So it's taking a breather. Some of these stocks, I don't know if they're taking breathers or structurally they've lost the bid. Because once you've lost the bid, once you've lost the momentum, once you've lost the narrative, I mean, it's really hard to get it back. And so that is my question to everybody. My final take on this is very simple. I think to keep the bull market going, you need quality companies like an AMD or an Apple that hit all-time highs yesterday to get those all-time highs. You cannot have a meaningful bull run when you have lots of stocks, there's like over 30 to 40 of them, that run up for no reason. And again, those stocks could go to zero, doesn't affect the broader market. Those stocks could go up to 30, 40 billion market cap, probably still doesn't affect the broader market, but it's not healthy. We know it's not healthy. If we're not kidding, if we're calling a spade, we're not kidding with ourselves. We know that's not healthy. And so it's not about being bearish the market. It's ironically being as bullish as you can about the market, and to keep that bull market momentum going. Everything shouldn't be running for the hell of running. That is not a bull market. That is a bubble. That is a top. That is euphoric. That is what we saw in the dot-com bubble 2021. And given most of us lived through 2021, not everyone lived through 2008 or the dot-com bubble, but 2021, these stocks didn't deserve their multiple. They got the multiple. And we're not just talking about the random stocks. We're talking about the Metas, Nvidias, Amazons, et cetera. The fact that those stocks, Meta, Amazon, Google, et cetera, are not getting a massive multiple, but these random stocks are getting a massive multiple, I think is bullish, because it means there's not a bubble in the big stocks. And now if those random stocks can lose their froth and the big stocks can slowly continue to expand their multiple because it's justified on earnings growth, I think that's one of the best case scenarios for the broader market. But very curious to hear what people think. Momentum stocks potentially losing their momentum, might end up coming back, but we're going to have to give it a lot more time to see what the data tells us. Okay, next up is what's going on with Amazon, Google, and OpenAI. So Google fell intraday to 245. We were actually live on the market open. I think it actually got to 244 when this happened. OpenAI announced a new browser called Atlas. And when the browser was announced, everyone shrugged. Anyway, so the browser I thought was kind of interesting. I'm a bit skeptical on the idea of the browser really mattering. I mean, look, I use Chrome.
Google,
when this happened.
Google just did actually kind of get beat up here at about, well, that is not Google. Goog, Alphabet. So Google did get hit up, but really not by that much. So on the day, it looks like they were about 2%. They almost got all that back by the aftermarket. Yeah, the market just kind of just said, meh. Like, this is no impact to Google. OpenAI browser. So OpenAI came out with their browser. So what that looks like, introducing ChatGPT Atlas. So let's see what that looks like. Atlas. But I have a feeling it's not going to be anything that's going to replace what people do currently. So let's check out what Atlas is here. There is a 6-minute video. Let's check it out.
Hey boss, just arrived on site. Business with.
I just got access to the new ChatGPT Atlas agentic browser, and right now I actually have it going and responding to my LinkedIn messages for me automatically, all while it's finding a recipe for me to make pasta for tonight, and it's adding these ingredients to my Instacart, all while my hands are off of the keyboard. In this video, I'm going to break down what the ChatGPT Atlas release is, how this AI web browser might be the future of how we interact with AI and interact with our computers, and by the end, you'll see exactly what it is capable of. What I'm going to do is I'm going to come here. There's a link in the description to actually sign up and download this. I'm going to download this live right now to my Mac. Here we go. We have our app. We're going to download this, and I'm going to open it up right now. So first of all, it looks like it's asking me to log in with ChatGPT. So let me go ahead and do this. I'm going to click log into ChatGPT. Also, guys, I'm trying really hard to get this video out as quickly as possible. I'm going to try to get it out within an hour of the actually Dia browser. So I'm going to import that right now. I'm going to allow access. It's asking if I want to turn on browser memory. So this will essentially have the ability to search through all of your inquiries that you've had with ChatGPT Atlas, ChatGPT on any website in minutes. And let me go ahead and play around with this now. So what I'm going to do, let me just ask for it to actually go ahead and find me a recipe. Then I'm going to see if it could actually order these ingredients for me using the agent mode, which is the really interesting part of this release. All right, so here we go. Here's my prompt. And this, I'm interacting with this just as if it were ChatGPT. I write in the prompt, and you can see it's actually beginning to search right now. All right, so this all looks good. It actually gave me this recipe, creamy cottage cheese pasta and veggies. Let me go ahead and actually tell it to go and order this for me. I'm asking, can you go ahead and order these ingredients for me on Instacart? And I'm just clicking this plus button, clicking on agent mode. And now what it's going to do is it's going to go ahead and actually log into my Instacart account and begin actually adding this to my cart. And I'm going to show you exactly how this works. So I'm getting this message here. So agent mode may introduce risk. So logged in, when logged in, ChatGPT can access your logged in accounts, making it fast accounts. You can do that. Otherwise you could. So I'm going to go ahead and enable this. And just like that, it's pulling up this agentic workflow where it's scrolling on Instacart, clicking on these different ingredients, adding them to the cart, and it's going to go ahead and order these for me, searching for all of these ingredients. And one thing I want to mention is if you've ever used ChatGPT Agent, it functions very similar to this, but instead, inside of ChatGPT, it's directly baked into your browser here. All right, so while ChatGPT Atlas is going ahead and performing this task, let me see if I could actually perform another task while that's going on. Click on agent mode. I'm just going to describe the task I wanted to perform. I want you to go onto my LinkedIn and find the last 3 messages that I received. Give me a TLDR in 1 sentence of each of these messages. Okay, so I'm giving it that task. I'm interested to see if it could actually pull up my LinkedIn, log into it, and even access the messages that I received by clicking through my profile. Pulling up this browser tab here. Guys, this is so cool to see this in action. I know Perplexity Comment already does something similar to this, but the fact that we could have a browser scrolling through and performing tasks for us is pretty crazy, and this is integrated directly with ChatGPT now. Clicking on each of these messages here, guys, this is really cool. Boom, and just like that, you can see on the right-hand side, it pulled up these 3 last messages. If I want to open up the ChatGPT menu, I can just open this, shows full screen, and then I could just, describe another task and it will go off and do it. So now that I did that, let me go back to Instacart and see if it was able to actually perform this for us. So here we go. All of our ingredients now are added. You can see it even understood how many pounds of chicken to add. So 3.25 pounds of chicken. And I didn't have it go ahead and check out for me, but I could click go to checkout and basically put my card information in and check this out for me. All right, guys, now that you can see kind of a little bit of the capability of this, let me talk about something that a lot of people probably are thinking about, Perplexity Comment. So if you don't know what that is, it's basically Perplexity's own browser that does basically the exact same thing that the ChatGPT browser does. The question that I'm interested to find out is which is faster, which could do more things, and does ChatGPT Atlas, does that have context to my actual ChatGPT history when I go to the actual ChatGPT app? These are things that I'm asking myself because if it has the ability to have context on my ChatGPT conversations that I have, I think this is much more valuable than using something like Perplexity Comment. Let me say, what is my last video idea I had because I was actually brainstorming with ChatGPT. Boom. Okay, so this does have full context on me. So this is very interesting. The fact that I'm able to integrate this with all of my ChatGPT memory, this is going to be really impactful for me to use. So right now, I've actually been using something called Dia Browser, which has similar capabilities. You can see I could pull up this chat window. It has access to any of my tabs that I have open. But I do think I'm going to transition to ChatGPT Atlas to at least try it out and see how it works for myself. So guys, I know this video might have been...
Okay, so ChatGPT Atlas. So to be honest, this is going to be a whole bunch of baloney. It's not going to matter. As we see, the market kind of just shrugged it off like it didn't matter at all. Obviously, when ChatGPT dropped their Atlas AI agent that kind of helps you, on your screen, orders, and does the things that you would normally do on the daily. For example, if you wanted shoes that would fit your size in a certain color, you can describe that and you would tell it, go shop for me on Amazon, and it will go find the shoes, maybe give you 5 or 6 different brands, and then it'll put it in your cart, and the next thing you know, you click buy, and then you would maybe say, hey, find any promotions and include those promotions as well. So at the end of the day, maybe there's, obviously, I'm not going to say maybe, there is business for this, but this shouldn't be anything that's actually going to impact Google, because 100% Google has something like this. Google has something like this in the works. And no matter what ChatGPT comes out with, Google is going to be right there. And Google cannot show everything they do. Like Google has Quantum, it's got the ability to do their Gemini, generate images, videos, VO3. Google has so much going on for them that ChatGPT dropping anything like this is actually going to impact what? It's going to impact how Google should perform in the long term. They're one of the largest, one of the older, mature AI companies that is actually adopting. Google doesn't benefit by dropping all these new products before any of these companies. They don't benefit from something like that. They need a small company to introduce the idea, and then Google comes out and says, we can do that too. Because at the end of the day, are already in litigation for being a monopoly and everything else like that. So they don't want to monopolize the entire market. They want to give the small guy some headwind, backwind, whatever, however you say that, some help or the ability to drop a product, and then Google is going to come back behind them and say, yeah, we've been also working on this. So a lot of these AI companies are already probably producing something like this. Perplexity also have the Comet. Google probably is going to come out with theirs in the next month or two, saying, oh, we can also do it. So the market also believes the same thing. So it's not, I don't see this being a big worry at all.
Chrome, I'm sure a lot of people use Chrome, Safari, Microsoft Edge. I mean, like it's just one of those things where for us to switch to a new browser, and when I mean us as consumers, because of some AI bot on the side that you can ask questions to based on whatever webpage you're on, which is essentially what Perplexity launched. And I tried it. I liked it. It was cool. It didn't get me to stop using Chrome. This OpenAI thing, I don't know if I'm going to actually stop using Chrome, especially when Chrome adds it to their browser. Like a lot of these new innovations I'm seeing by some of these companies, you look at big tech and you're like, man, big tech's going to be able to do that. And they have the distribution, which is the most important thing in the world. Ironically, Austin made a good point in the chat today that Microsoft Bing is a browser, Microsoft Edge, but Bing is like their search thing for Microsoft. The fact that OpenAI is not working on making that better and like interacting with Microsoft to like already serve the distribution that Microsoft has, which is pretty massive, just means that OpenAI doesn't care about Microsoft. And this relationship with Nadella might not be as good as it seems in terms of a working relationship. And so they're doing it on their own. Google fell to 244. Google's back up to 252. In fact, Google's even more green after hours because there is a rumor from Bloomberg that Anthropic, which is one of the leading LLM companies, is now going to be working with Google for a cloud contract, which will include tens and tens of billions of dollars. That is the exact headline that we have. Google right now after hours is up 2% at 255.75. I think that's really interesting. And one of the reasons that's really interesting as well is because Amazon already has a deep relationship with Google. Amazon's actually down 1.5% after hours. Amazon was up almost 3% of the day. A lot of that froth momentum stock potentially, people took profits and got into something safer like an Amazon. But Amazon's down after hours because Anthropic, which they own a majority of, I think a majority of over in the context of Google, it's almost like a $4 or $5 billion stake. Well, Anthropic is deciding to go with Google for cloud computing over AWS. What is my take on this? I think two things. Number one, the OpenAI browser is not killing Google. So I think Google going down to 244 today was a gift for shareholders, and I thought that was stupid. Makes sense that Google recovered. Number two, I think AWS is a massive business based on what we saw with the AWS outage yesterday. That was crazy. 76 million websites run on AWS. And I think the moat for AWS had a bit of a CrowdStrike moment back in July of 2024 when something goes down, everyone realizes how unbelievably important it is today, which is part of the reason I think Amazon was actually up 3%.
This credit card has an interest rate that's really, really low. How low? This low. The credit card that's in your wallet right now probably has an interest rate that's really, really.
However, it is not bearish for Amazon to lose Anthropic or to not get as much money from Anthropic, because I think for Anthropic, OpenAI, Gemini, XAI, all these foundation model companies, they are trying to diversify the cloud computing and hyperscaler companies that they work with. I mean, Oracle, AMD, Broadcom, NVIDIA, all of them are working with OpenAI. A ton of them, by the way, Mizuho came out today and said that Broadcom's mystery client that's going to be paying them $10 billion in revenue, that is probably Anthropic. So you've got a lot of these companies diversifying the cloud spend that they do. Yes, that's less revenue going to AWS, which could potentially be bad for Amazon Web Services, but that doesn't mean that they shouldn't be working with Amazon. In fact, there was a report that came out yesterday that said Anthropic has paid Amazon already $2.6 billion in the past 9 months just for AWS. So I wouldn't say it's bearish AWS. It's just more bullish Google because now some of that money is going to Google. Now, the one thing about AWS that I will say is that although they're getting a ton of business from Anthropic and now Google potentially is getting some of that business as well, I think AWS could hurt Amazon on earnings, and I think the stock could go down below 200 if AWS shows any level of deacceleration or the guidance isn't that good going into Q4. And why would the guidance not be that good going to Q4? Well, they just had an outage. Now, I think the service credits that they are going to have to give out to a Robinhood that was down for 10 hours and Coinbase was down and Snapchat was down, Slack was down, et cetera, that shouldn't be that big of a deal. I mean, that should be kind of like maybe tens of millions, maybe hundreds of millions of an expense for Amazon. That shouldn't really make a difference to the bottom line. But if AWS doesn't accelerate, or if there is no potential hope of acceleration based on this earnings, and the rest of the business around commerce and advertising and all that stuff is just flat or like not that exciting, yeah, I could see Amazon tanking. I really could. We're going to talk about Netflix in a second. Netflix tanked because they couldn't beat their estimates. I think that would be a buying opportunity. Again, I'm buying Amazon as a cornerstone stock of the portfolio. I really don't care what happens in the short term. 10 years from now, I think Amazon is going to be a much bigger company. But AWS acceleration will help the stock go up after earnings. If we see any level of just like basicness, Street wants 18% growth. They come in at 17.9 or 18.1. If we don't get a real beat, I think the stock is flat or it sells off, which is okay because long-term, I think AWS is going to be a very, very important business for Amazon, and that's not slowing down anytime soon. It might not be accelerating to the level of a GCP or Azure. Now, the question then becomes, well, do I sell Amazon and get Microsoft and Google? Sure. It's just that's discounting everything else that is important when it comes to understanding Amazon. It's also discounting the fact that Amazon is red year to date. Google and Microsoft are up a lot. So I think the risk reward might be better in Amazon. But then again, these are Mag 7 companies where whichever one you buy over the next 10 years, theoretically, all of them should do really well.
Amazon as a company to buy. So Amazon has great potential here as a company to kind of to look at, to invest in.
However, that is something to watch out for going into earnings. AWS needs to grow. We know how important AWS is based on the outage yesterday that shut down half the country, at least in the United States, in regards to the internet that simply didn't work for a lot of these companies and websites. But any deacceleration, the stock could get hit going into earnings. All right, Netflix earnings. Let's get into that. Look, Netflix didn't have the best earnings, and it's kind of weird how these earnings turned out. If you were live in the market close, you saw the reaction to earnings down 7% after hours. Kind of feels like it's isolated to Netflix, but
I've been excited to receive this for a very long time. The book, The Ultimate Guide to Rebuilding a Civilization.
It's not the best. So they missed on EPS by 16%. And the question becomes, why did Netflix miss as badly? By the way, Capital One, Intuitive Surgical, a lot of other companies had great earnings. Chubb Limited, insurance company, that was good. Texas Instruments missed EPS by 1%, beat revenue by 2%. But Netflix is kind of the main story right here. So 587 versus 697. That's what the street expected. That's why you had that massive move down as soon as the numbers came out. 11.5 billion on revenue. That came in line with the street's expectations. Now, what did Netflix give as the reason for why they had a crappy quarter? Well, operating margin was 28%, below the guidance of 31.5%. That's not good because that hurts EPS. And that's why you saw that EPS miss. And then the reason for this is because they had an ongoing dispute with the Brazilian tax authorities that was not in their forecast. So Netflix is blaming the Brazilians. And that's why the stock is down. Operating margins for 2025 came in line with expectations for Q4. So for the fiscal year, it was okay. For Q4, it is 2% above year over year what is expected. It is down 5% for the quarter on quarter. That tends to be what happens to Netflix in Q4, but nonetheless, it's not like a massive reacceleration in operating margins going into the end of the year. My take on this. I mean, look, Netflix at the end of the day, phenomenal company. If you're a long-term shareholder, you probably don't care that much because Netflix over the next 10 years will be a bigger company than it is today. The broader issue with Netflix, I think right now is this idea that, hey, look, stock's up 40% year to date. You've got tons and tons of, we're talking about hundreds of millions of subscribers that are on the platform. How does Netflix grow? And ironically, one of the stories we talked about in the market open this morning and why WBD, Warner Brothers Discovery, was up 10% of the day. There are rumors, as per Bloomberg, that Comcast or Netflix is thinking of buying Warner Brothers. And you've got some really important media properties there like HBO Max that a lot of people already pay for separately, including myself, even though I barely watch it, so I don't know why I pay for it. But HBO Max could be integrated into Netflix. So I think the EPS miss based on Brazilian tax authorities, the street will forgive it. Not that big of a deal. Stock's up 30% year to date, or 40% year to date now, 35%. And overall, it has been proven to be recession proof. However, if we do have a recession, I don't know if people are going to be that quick to not cancel their Netflix or other streaming subscription service providers because maybe the content is just not that good enough and people say, I don't care. And the other problem is the Elon Musk backlash around sensitive content for kids that has been on Netflix. I think the sort of like cancel your Netflix movement started in October, so I don't think that had an impact on Q3. Potentially will have an impact on Q4. But if it happened towards the end of September and Elon Musk, who has 250 million followers, got people to unsubscribe, that's not the best thing for Netflix either. So look, at the end of the day, I don't think this was a quarter that people should be upset about. I don't think this is indicative of big tech in general missing on their earnings. If big tech does miss on their earnings, it's not going to be pretty. But Netflix did. Seems like it was isolated because of Brazilian tax authorities. Overall, I don't think there's going to be any broader issues with Netflix. I will say, though, just as a content creator, I'd rather buy Google over Netflix. I mean, if Netflix does acquire Warner Brothers Discovery, that would be a $30 to $40 billion acquisition just to get content onto the platform. Google has creators that connect with audiences, and as a result, Google doesn't really need to pay for the content. Google just creates the platforms that allows people to produce the content. So I think both are phenomenal companies. I would not want to be paying the multiples that Netflix is trading at right now that are more expensive than NVIDIA. I would rather just buy Google. But long-term, I think this is a nothing burger for Netflix. It's just one of those quarters where they had a Brazilian tax issue, and that's why they missed on earnings. All right, last thing we're going to talk about today is what is going on with gold. Gold took a pretty ugly hit on the day, down about 1.3%. And I mean, look, or sorry, not down 1.3%. It was down a little bit more than that, down about 5% on the day. So here's the question to everyone in the chat. This was the worst day for gold since April 2013. Lost $1.75 trillion in market cap. Is gold a bubble? I hesitate to say it's a bubble. I think it is getting overcrowded, and I think some of that frothiness of the overcrowdedness of the trade kind of left today, which is probably bullish. Silver, by the way, down 7%, so silver and gold both took it on the chin. I will say that we looked at a chart last week that says central banks are now having 20% of their reserves, 20% of all central banks globally, in gold. Gold is being treated like US treasuries, and because the dollar is going down, you might be saying people are using gold as a hedge. Now, again, the 10-year going down is weird because that means people are not anticipating inflation. Gold going up at the same time is, again, weird because people are anticipating inflation. So why is that happening? One argument you can make is that geopolitically, the reason gold took a hit today is because there is a bit more peace in the Middle East with the Israel-Hamas deal. There might be some peace around Russia-Ukraine. And if that geopolitical instability starts turning into stability, which really over the past 2 years, we haven't had that much stability, and that could also explain the massive 70% move that gold has had this year. If that starts to become more stable, it might not be that.
The viral Paleo Valley meat sticks are on sale right now for up to 20% off. These are the most delicious meat sticks on the market. There are tons of flavors and they're naturally fermented, so they're nice.
Bad for gold, or it might not be that good for gold, which ends up becoming more ugly, to the downside in terms of price action. The other narrative here is retail euphoria. I don't know, and I think I asked this question on a daily recap on Wednesday last week, how many people are in gold? And, I think 5% of you in the comments said you're in gold, but the majority of us are not in gold. Ironically, Bitcoin was up 2% today, so maybe there was a rotation out of physical gold to digital gold. So my take here is that I would not touch this trade because I think the risk of being wrong and entering into a very crowded trade that is now going to have the bottom potentially fall out, which doesn't mean gold has to go down 30%. But if gold goes down another 5%, you're going to get a lot of people that are like, why am I in this in the first place? And you might have more sensitive pricing action in terms of the selling. But if central banks buy the dip on gold, which is possible if they're thinking of gold as better than the dollar, then maybe gold's going back to 5,000. I think it's really hard to make the prediction right here unless you have a sophisticated understanding of commodities. Silver going down 7% today also wasn't the best. But because I don't have that really sophisticated view of commodities, and because I'm not willing to take a chance on something that's up 70% year to date, that never goes up 70% year to date, like that doesn't happen for gold, I'm not willing to jump in at these levels. Ironically, I would actually rather buy Bitcoin. I feel like it's a little bit more of a hedge against currency debasement. And as a result, Bitcoin only moving up 15-20% this year versus gold, maybe it ends up becoming a better opportunity. But at the end of the day, the move in gold can't be understated. Losing a 5% rally or losing a 5% move on today's price action after a 65% rally makes you wonder, just like the high momentum stocks we talked about at the beginning of the show, is it structural or is it a breather? I think we need some more data to see, but if it is structural, then you might have a lot of that money exiting into the asset class. And then the question becomes, where does that money go? Money market funds, S&P 500, NVIDIA, Google, that is the broader question, but it does seem like some of that momentum is getting hit. And so I think over the next couple of weeks, the question is, can gold regain the footing? Is this a buy the dip? Do central banks come in? Does retail come in to buy the dip? Or is this one of those things where, look, it had a good run and it's going to chill out, consolidate for a bit. Maybe it goes sideways. It doesn't have to tank 20%, but it doesn't have to go back up 20%. And that wouldn't be the worst thing in the world for gold. All right, that's it for me. Thank you, everybody, for listening and watching Deeply.
All right, thank you, Amit. That was an awesome interview. A summary of what happened in the marketplace. I am going to continue looking at what's going on at the rest of the market, but I think I might kind of focus on I'm gonna try to yeah, AMD is such a good investment though. 2012 revenue dropped, 2013 introduced APU, 2014 Lisa is, yeah, this is pretty cool. Lisa really took this company, from death to being one of the most successful companies out there. But let's look. I kind of want to look at Amazon. To be honest, I think there is Amazon might just be undervalued right now, and maybe there is something that we can glean from this. So Amazon right now is, so let's look at what's going on at the company. So I'm sure a lot of people know Amazon, what they do. They ship your products. Ship your products. You can buy stuff. Small business. All right. Obviously, you can't find it. Brand. Okay. Let's go Amazon Invest IR. Obviously, most people know what Amazon does. I mean, they, you can buy a bunch of products from them. You can use their Twitch. You can use their Amazon Web Services. Press investors. Annual reports, quarterly proxy, shareholder letter, quarterly results, press release, corporate governance. Let's look at this annual report. Maybe they'll provide some information here. Annual report, shareholder letter, quarterly results, investor presentation, earning release. Let's look at the PDF. All right, so just gonna do a quick review of how just Amazon does, where they make the money and everything else. I'm gonna try to fly through it, and I'm not gonna brands. I'm not gonna try to focus too much on their financials within their earnings report. But what I'll do is like where they're making most of their money will be an interesting fact to see. So how does Amazon make money? Basic question there. Amazon investor presentation. Overview. Hopefully they have something that we can look at here. All right, so Amazon makes money through several key revenue streams. So Amazon e-commerce sales, subscription services, Amazon Web Services, and obviously advertisements. So these are the key ways that Amazon makes their money. And obviously, everybody knows what Amazon does. You buy products from them, and you can subscribe to their Amazon Prime movies. You can get Amazon products. There's a whole bunch of stuff. So from an advertisement perspective, from an ad perspective, obviously they'll get there. But obviously this doesn't show, the whole picture. There's a lot of other services that Amazon does that this is not talking about. Maybe there's a good map that we can look at on the site. Let's see, is there a map of how they make money? Okay, so where do they make money? Segment breakdown. So North America makes obviously about 62% of their revenue, and 44% of their operating income, and then international makes 23% of the revenue and 6% of operating income, and Amazon Web Services, it makes about 15% of the revenue at about operating income of 50%. Obviously, there isn't a lot of expense when it comes to Amazon Web Services, because it's a product, you have it there, it continues to run as long as everything's okay, or until something goes down. Obviously you have to frantically fix any problems that might come up. So let's look at what analysts are saying on this company. So from a financial perspective, right? So we're seeing that Amazon is making decent money for the past year. So starting fiscal year 2020, this company is growing revenue at an average, let's say, of about, would say 20%. So they're making money at an average of about, not 20, about 10%, maybe we could say. Trailing 12 month, they've already hit that. From what we're seeing in earnings, companies are hitting their guidance, right? There's no, like, if we look at what went on here, we're seeing overall companies are beating earnings, right? We're not seeing consumers kind of slowing down, businesses slowing down, and so there's probably more growth more growth that Amazon's going to end up showing. So we have the revenues that are growing already in the trailing 12 months. We've seen great revenue. Cost of revenue, this usually always follows revenue, but this isn't too fast of growth at all. So gross profit, we're seeing this company hit gross profit year over year over year. Selling general administration expense, obviously that is kind of staying consistent. It's not growing too fast at all. Operating expense, obviously this gigantic company, their operating expense is going up since 2020. 2020 is not really, a good number to look at. It's getting out of the pandemic era. 21, 22, 23, 24 are the real numbers to look at here. Looking at 2021 financial year operating income, they made 24. They lost a significant amount here in 22, and then in fiscal year 23 they hit about $36.8 billion in operating income, and then they're growing that again. This is almost an 85% growth in revenue, in operating income year over year, and they've already hit that $76 billion in trailing 12 months. At net income, this they're hitting about 33 billion, lost about 2 billion. Now they're actually hitting these huge net income numbers. For a company, it's really crazy to think about, like, for a company this size, with all of the products that they have, they're still making net income at the bottom, and they're making it in the billions, and they're actually growing it significantly. It's not easy to have revenue grow at 94%, going from negative in 2022 to 30 billion, 60 billion, 70 billion, probably in the $90 billion maybe by the end of the year. We still got a whole quarter that we have to go through before the end of the year. So this company is making good money. Obviously, I have a feeling their balance sheet is going to be really good. Looking at their current assets, current ratios, you got the current liabilities here and current liabilities here, and you got their current assets here. So you have about more assets than liabilities. That's always how you want to be. In 2022, it looks like they ended up having way more short-term liabilities versus the short-term assets. Here, it looks like they started picking up here, and it looks like they kind of keep their assets and liabilities close in line to continue grow and finance their business, and the fact that they have enough assets to cover anything, and that's anything that they might get hit with, that they can sell out short-term assets to be able to kind of cover anything that happens. So you have about 231 in total, 321 in asset in millions. So you have the total long-term assets versus total liabilities. So more assets than liabilities, way more assets than liabilities, and again 500, 300, 600, 300. So long-term liability is kind of just staying consistent while the company is growing the total assets. So that is, I would say, a healthy balance sheet. As long as you don't overfinance what you're doing, I think that is just great business. So then we're going to go into we're going to see here is just what analysts are saying. Analysts are saying, you know what, there's still, according to what analysts say, there's still an upside of about 19% from where it is. So right now, Amazon is selling at $222. Analysts are saying, you know what, the stock should actually be at $264. So they're saying by the end of the year, you know, we could hit, the highest analyst is saying should be 305, you know, but also by the end of, well, by in a year, in a 12-month period, it could be $195 a share stock. From a buy sell, there's a whole bunch of analysts. Obviously, this is a large company that cover Amazon. We're seeing 24 analysts saying it's a buy. If we look across, we see a little bit of some analysts kind of dropping off from the hold. No analyst is saying sell or strong sell. Most analysts are saying, you know what, this company's a strong buy, or is a buy, or is just a buy. So I think there's definitely, I kind of agree. The Amazon is not getting the fair treatment right now, and maybe, you know, they got hit with the whole situation that happened around Amazon Web Services. But overall, we're seeing the analysts are saying Amazon is a buy, and I think no one is saying to sell Amazon as a stock. All analysts are saying is just continue to buy. If we go into the revenue forecasted to continue to go up, the lowest being $732 billion, the highest being at that $843 billion, 12-month period by 2026. So analysts have, you know, pretty big expectations for this year. They're saying, you know, the highest is about $750 billion, and we just saw the financials. They're close to that. They're close to that already. So I have a feeling that they're gonna hit that. Revenue growth, analysts are expecting by the end of the year that they're gonna hit that 17% at the highest, and then about, you know, the lowest of about 6%. The earnings per share, you know, we have by the end of the year, we have that they're saying about, you know, $8.72, and the lowest about $5.89. So overall, it seems like, you know, analysts are saying Amazon is definitely a buy, and that you have some of the largest, Eric Sheridan, I don't know how to say that name, but he's saying it's a strong buy. This guy went from Wells Fargo, he's with Wells Fargo, analysts saying going from a hold to a buy. So you have a lot of analysts just continuously saying it's a buy. So Amazon stock analysis. So I kind of want to find a video here of somebody really getting into Amazon and kind of giving their thesis around the company. So let's go.
Hey everyone, in this
we're gonna look at this. Couch Investors are actually pretty amazing. I like the way he breaks down companies. So let's watch this.
Amazon is a very interesting case to study because Amazon is a tremendous company, yet a tremendous company has underperformed the market by quite a lot. Over the past 5 years, the stock is only up 41%. So it's underperforming the S&P, it's underperforming the Nasdaq, and of course it is underperforming its peers. Now Amazon right now is a company worth $2.37 trillion. Trailing PE looks much better today than it was before. It sits at 33.9 times and a forward one of 32.1 times. Now Amazon is my second largest holding in the retirement portfolio behind Meta. Meta is number one. Amazon was number one for a long period of time. Meta is number one because I loaded the boat back in 2022. Then it's Mercado Libre, Tesla, and I own even more Google in that portfolio. I've been owning Amazon since 2018, since the first trade war with China. And so in today's video, I do want to touch on the Amazon business, right? It's of course a business and a name that we know very well, but I do want to touch on the, well, underperforming part of it and where I see it going from here. So if you're interested in that, hit all the buttons. We'd really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/CouchInvestor. Thank you very much. And also special thanks to Fiscal.ai for sponsoring this video. Everything you see here, every piece of information comes from Fiscal.ai. There is a link down in the description and in the pinned comment. You'd get 15% off if you use my link. New users will get Fiscal Pro for 2 weeks for free, so you can try it out. Now, of course, when we talk about Amazon, either we think about the online stores only, right? Because that's the biggest segment over the last 12 months that has generated $255.8 billion in revenue, and that's growing still 8%, 7% or so year over year. Or when we think about Amazon, especially as investors, we think about AWS. And AWS is a business that is generating or has generated $116.3 billion over the last 12 months, and that's growing 18% year over year. AWS is still number one when you look at AWS, Azure, Google Cloud, Alibaba Cloud. But AWS is also the one that is not growing as fast as the others. And that has been one of the issues around the stock and maybe around Andy Jassy as well, is that the messaging behind this doesn't make much sense. Right, we see CapEx increase, we see all of your competitors grow and increase CapEx as well. So why aren't we seeing this with AWS? Or why aren't we seeing it with AWS just yet? Well, first of all, the size of the business is different. Right, the dollar amount that AWS is adding is of course much bigger than the others. But still, there is a question about, okay, growth rates. Why have the growth rates not been like Azure and Google Cloud? Okay, Google Cloud is much, much smaller, which is also why margins for Google Cloud are lower than AWS. For example, AWS last quarter, operating margin here of 33%. Quarter before that was closer to 40%, 39% or so. So, of course, a huge difference between an AWS and a Google Cloud right now. But as I've shown you time and time again with Google Cloud, that is going up and to the right while Google Cloud becomes bigger and bigger. Now, the thing here is with AWS is that growth is expected to reaccelerate. If we go and look at SemiAnalysis post here, they look at AWS year-over-year growth on a constant currency basis and the forecasted growth. So they do forecast that growth is about to accelerate. And when you have such an acceleration of such a huge dollar amount, well, things are going to get very, very interesting for Amazon and AWS's business. The first catalyst here is Anthropic's first AWS gigawatt scale cluster that will begin operations. And then we have the second one, which is basically for the next quarter. Second AWS gigawatt cluster begins operations. It's a bit like the Oracle OpenAI or maybe also Azure OpenAI combination. And so yes, while right now we are only growing 18% year over year, it's a business that generates $116.3 billion per year, but it's only growing 18%, right? What happens when we suddenly start growing 20% year over year? This is going to become an even better money-making machine that's also very, very profitable. And then I do think you're going to see the business, especially at the bottom line, start to change completely. Now, like I said at the start, it's not just AWS. If we do look at the fastest growing businesses, which are also higher margins, and here I am excluding AWS because we just talked about it, but I am showing you the comparison. This type of green here, that's the online stores. All the rest, third-party seller services, advertising, subscription services, are faster growing segments that are also higher margins. And as you can see, over the past 5 years or so, these businesses have grown faster than online stores. Growing faster, higher margins, which means that Amazon turns into a more profitable business. I don't see this changing anytime soon.
Hey everyone, in this guide we're introducing our new AI indicator which we developed in partnership with OpenAI. This is the first trading indicator of its kind using artificial intelligence to analyze multiple market factors, save you countless hours of market research, and help you conduct professional grade analysis on your own. Now, let's dive into the guide. As many of you already know, earlier this year TradingView officially partnered with OpenAI, the creators of the widely known ChatGPT technology. Together, we've built the AI indicator and integrated it into TradingView. This tool was designed to help traders make smarter, data-driven decisions by combining advanced AI with TradingView's powerful charting capabilities. After 7 months of testing and refinement, the indicator processed market data consistently across various testing scenarios. It's like having your own personal assistant who knows the markets better than any human ever could. They spot trends, predict opportunities, and give you the edge to stay ahead in the market. They help you assess risk versus reward, track which coins large investors have been accumulating in recent months, and identify assets that may be better to avoid in order to not become exit liquidity. Of course, you could try to find all this information on CoinMarketCap or DeFi Llama if you're willing to spend hours digging through the data, but with our tool, you can make smarter investment decisions in just a few clicks. The indicator is currently in beta and available through developer mode, completely free during this testing phase. And now we'll show you how to set up the indicator and walk through a few practical examples of market analysis. Now, let's begin by setting up the indicator. Step 1, launch TradingView desktop app on your computer. If TradingView is not installed, you can download it by clicking the More button in the top menu on the official website and selecting Desktop App. Step 2, after completing the installation, switch to developer mode via the command line on your computer to enable the AI indicator. The process is super straightforward. To do this, press Win+R, type command, and then press enter. Alternatively, you can click the Windows Start button in the bottom.
If we actually go and look at, for example, the advertising and the subscription business, first up, subscription. Amazon has more than 200 million global Prime members, with the most recent data indicating over 240 million members by mid-2025. And according to some estimates in the United States alone, that's between 180 to 197, maybe right now already 200 million members, just United States. I still think that Amazon Prime is the best subscription in the market. You get, of course, good deals on Amazon, you get super fast shipping, and then, of course, you get the Amazon Prime Video entertainment. Yes, different locations, different prices, different services. For example, in Belgium, I barely pay anything for Amazon Prime because, of course, I'm not getting the same service as you're getting in the United States, for example. But I do think that as they add more value, the subscription price will go up. And if the value goes up, why would I unsubscribe? Just doesn't make much sense. Then if we look at the advertising business, this is Amazon, the yellow bar right here. Over the past couple of years, that has grown at a compound annual growth rate of 33.2%. YouTube ads has grown by 18.3%, Meta advertising by 18.2%, and Google search and others by 14.7%. Now, if we go back here on fiscal.ai, we can actually look at the advertising business, look at the year-over-year growth rates. Again, over the last 12 months, this is a business that generates $61.2 billion in revenue, growing 19%. I mean, I think they can continue to grow 19-20% or so for the next 10 years. This is, of course, high margin business. Looking at the other business, the subscription services one, this is a $46.7 billion business over the last 12 months, growing low double digits, in this case, 11%. Can it continue to grow 10-11% or so for the foreseeable future? I think it can. I think it can. So if you just take advertising and the subscription business, you already have an over $100 billion business over the last 12 months, growing double digits. What type of multiple do you want to put on that, right? It's quite incredible what kind of businesses Amazon owns. And we are just always talking about either AWS or some people just think it's just Amazon.com. But Amazon as a business has tremendous value with these sub-businesses. Then moving on to the why has it underperformed and why will it outperform in the future? First up, let's have a look here at EV to operating cash flow to actually see how profitable the core business is, or the pricing of the core business. Right now, we're seeing trailing EV to operating cash flow, 19.9. The average of the past 10 years was 27 times. If we look at the forward one, that's 15.1. The average over the past 10 years, 19.5. So of course, You're paying less today than you were before, because today I do think that the business is, of course, better than before. And we can see this right here, free cash flow compared to operating income. Look at the huge difference right now. Huge difference between operating income and free cash flow. Look at what has happened with free cash flow over the last 12 months, that is. We have reached a peak here of close to $50 billion in free cash flow. Since then, that number has come down. Of course, we also know what has happened in the meantime. CapEx has continued to increase. Last quarter of the last 12 months, that's over $108 billion in CapEx. I don't see this number becoming much smaller anytime soon. But yeah, the increase in CapEx, I do think that the increase is going to slow down a bit. And once CapEx starts to slow down, we should start to see how profitable the core business is going to be. The current projections are like this when you look at free cash flow. For fiscal 25, $23.8 billion. Then that jumps to $53.1 billion in fiscal 26. And then another 59% year-over-year growth in fiscal 27 to reach $84.6 billion in free cash flow. If we look at operating margin for the business, again here, last 12 months, we can see the huge improvement over the last 3 years. We went from 2.7% back in Q4 2022, Q1 2023 to now 11.4%. Now, as for the non-scientific part of the video, this is net income growth over the last couple of years, and this is the price of Amazon stock and net income. As you can see, it does follow net income. And lastly here, and I do think that this will change, this is the total shares outstanding. Over the past 10 years, we have seen it increase by around 1.3% compounded. So sometimes it grows 1%, sometimes 2%. Amazon is one of the only ones, I think, with Tesla that does not buy back its own shares. For now, Amazon is one of those businesses that they grow, but they continue to invest aggressively to make the business better, bigger, and stronger. But at one point, yes, at one point, I do think that this business will just be so profitable that they will start to buy back shares. This is also one of the reasons why we have seen Amazon probably underperform over the past couple of years. But I do think that that will change in the future as this company will just generate an insane amount of free cash flow. We are going to see the stock outperform over the next 5 years, or at least that's my prediction.
On August 22nd, I told viewers that the road to artificial general intelligence was already bringing massive changes to society and disrupting industries around the world. And to take advantage, I recommended buying a group of stocks, including these. Then, I told them to sell a group of stocks before they got wiped out on the road to AGI, including these 3.
Last 2 things here. One, today you're paying $0 on their version of autonomous vehicles. In this case, it's Zoox. I do think that in the future, you're going to see these types of vehicles, probably some fleets of them in resorts, hotels, especially they're already testing it out in Vegas, but I do see this format of an autonomous vehicle in resorts, in smaller communities, maybe colleges, schools. Maybe this is going to be also a type of delivery vehicle in the future, autonomous delivery vehicles. Maybe they're going to do this with their own vans, with Rivian, who knows? But currently you're paying, of course, in my opinion, $0 for this business. Another huge business is this. You might say, what the heck is this? Is this a video game? No. Robotics, small robots, huge fleets of those actually. In June, Amazon told us that they're launching a new AI foundation model to power its robotic fleet and deploys its millionth robot. Okay, Amazon, for some reason, everybody only talks about Tesla, Nvidia, and maybe the privately held companies as robotics plays. But Amazon is the robotics play. Amazon, Google is a robotics play, as I've shown you with the Gemini model that was released or that was shown more recently. But Amazon has over 1 million robots. Of course, we're not talking about humanoid robots, but we're talking about these types of robots. Why is it such a big deal? Again, when we talk about the profitability and the scale of this business, having autonomous robots run 24/7, do tasks today that they couldn't do before, or even if they have slight improvements from a profitability standpoint, from an efficiency standpoint, this is huge for a business like Amazon. And so they say it right here. We're also introducing a new generative AI foundation model we've designed to make our entire fleets of robots smarter and more efficient, called Deep Fleet. This AI technology will coordinate the movement of robots across our fulfillment network, improving the travel time of our robotic fleet by 10% and enabling us to deliver packages to consumers faster at lower cost. Again, this might not seem a lot, 10%, but when you look at the scale of Amazon's business, 10% is very, very big. And so do not sleep on Amazon as a robotics play. Last thing here, we do have an analyst note on Amazon from Mizuho. Outperform rating, price target $300. The upside here is 35% based on the current price of the stock. The key takeaways are AWS growth expected to be 22% or more in 2026 versus the consensus number of just 20% growth. Anthropic is scaling compute demand, which will support AWS acceleration, Gen AI proliferation to boost inference-driven compute demand, and North America retail growth seems slightly overstated, but AWS plus retail margin gains are more critical. Basically, the story is AWS growth reacceleration. Right now, when we look at the stock, we are here below the 50-day moving average, but over the 100 and the 200-day moving average. RSI is pretty neutral right now. It did reach here a peak at around $248 or so. Amazon is expected to report its next quarterly figures at the end of October. That's the estimated date at the moment. So this is it about Amazon, why it has underperformed the market in the past, and why I think it will outperform the market in the future, why it remains one of my favorite companies to own. This is it. Share your thoughts down in the comment section below. Hit all the buttons, check out fiscal.ai down in the description in the pinned comment.
Drowning while crunching those numbers on your options trade? Let Moomoo do the heavy.
With Amazon's AWS, or Amazon Web Services, reporting a relatively rare and significant outage today, I thought it'd be appropriate to reflect on Amazon stock. Why is Amazon down so far year-to-date 2025? Along with the question of, is Amazon stock on sale? So we're going to cover those two questions and more in this video. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. You're watching Unrivaled Investing. Now, if you don't have the time to watch this full video, you can go to Flash. I'm the co-founder of Flash. See the link below, where we are leveraging AI, the most powerful models that are currently available to users, to analyze stocks. And this is the take on Amazon, where it thinks it can go over the next 5 years. I generally think of AI at this current point in time as a junior investment analyst. And I look at this framework and I'd say, yeah, this is actually pretty good, in terms of how AI thinks it could perform, let's say, over the next 5 years, roughly 100% upside, roughly 20% downside. That's how it's thinking. I actually have a little bit more of an optimistic take on Amazon, which I'll walk you through this video, but it's going to require a little bit more analysis than just showing you this slide. So let's keep going. But this is, if you want to pull up any company anywhere in the world, check out Flash. It's free to pull up these company reports. And so the question of why is Amazon stock actually underwater so far year to date in 2025, that's going to be the first part of this video. I think part of the concern is the fact that Amazon is looking to spend so much on their infrastructure, their capital expenditures on their AWS business. They talk about looking to spend roughly on pace for $100 billion plus. I think just based on the most recent quarter, it's actually closer to $120 billion on an annualized basis. So that does cause investors to go, wait a second, I thought, just a year or two ago it was about getting back to significant free cash flow. And, they went from cash burn to a lot of free cash flow. And now that free cash flow is melting away as they're reinvesting. I personally think management, Andy Jassy, Jeff Bezos, thinking about that alignment, this management team knows how to invest for the long term, and they're making bets that generally make sense to me. So if management's saying, hey, we're going to be investing $100 billion this year, generally they know what a good return on investment capital looks like. So I think shareholders should actually applaud the news that they're going to be investing more and more. But I think what actually gives investors pause, one of the things, is also the fact that their market share in their core business, AWS, their web services, actually may have slipped this past year. There have been signs that they have been losing market share to faster growers like Microsoft and Google, which do show signs of increasing. And you could just compare by growth rates, where Amazon is growing, yes, significantly. AWS is still growing at a good clip, but relative to its competitors, it's definitely growing slower. And so this does suggest that there are these, players that are taking market share. And Microsoft and Google, shouldn't be ignored, in my opinion. I think another key aspect of why Amazon stock has come under pressure year to date is just the reflection that we are in a AI revolution. This is a very exciting, point in history. Microsoft has their alignment with OpenAI. Google has Gemini. What does Amazon have? Now, they do have some investments with Anthropic. So does Google. Google also owns a stake in Anthropic. So it's really unclear. Wait a second. How come Amazon isn't really pushing the AI race in the same way that Microsoft and Google have this sort of horse that can drive their cloud infrastructure? And so that I think is a common pushback, saying Amazon may have missed this. I mean, they do, once again, have a minority ownership. Maybe someday that turns into an all-out acquisition, but so far that's not the case. I think another reason why Amazon stock has come under pressure is just the concerns of, will governments around the world sort of go against big tech? And we've seen that initiatives across various different angles, one of which is the Federal Trade Commission, securing a historic multi-billion-dollar settlement against Amazon relating to their Prime subscriptions and making it difficult to cancel. Personally, that hasn't been my experience. And I think that does reflect that if the government wants to say, hey, we just don't like you, or we want you to pay me a few $billions, governments around the world will figure out a way to do that. They'll just make it harder to operate. And I think we are going from a cyclical perspective of going, hey, we should celebrate to these companies, which I personally believe in. This is a channel that's like, I want more billionaires, not fewer. I'm all for it. But I also recognize that we have maybe this push from a government perspective to say, maybe I don't like your political angle because Jeff Bezos also owns the Washington Post, and you know what, I'm gonna hurt you where I can, and we're gonna do it through.
What if there was a way to know if a stock will be bullish or bearish the day before? The truth is, there actually is one way. Is your trading account suffering right now, but you're wondering, what do I do to start winning consistently and start making those big returns you've seen other traders make, the returns that you know are possible? Here's the honest truth. I struggled like that for a while. Trading did not replace my job for 15 years until I basically had a stroke of luck. My cousin, who's a professional stock trader, making over $2 million a year, finally had me over to his house and show me some behind the curtain stuff, so to speak. I know that sounds a little storybook, but it was quite honestly the missing piece I needed to get to the next level. I was a decent trader before that, but once I learned to look at a specific set of market internals every day, which I call the market weather report, that's when things really took off for me. I'm actually a chef. You can look me up, Chef Michael Love. But I love trading, and I got tired of the hard work and long hours of being in the kitchen. When I finally cracked the code of trading, I was able to quit my job as an executive chef in Miami and trade full time. I started Trade With Me now because friends and family
trade practices. So you can have, that perspective. Even simpler answer for why Amazon may have come under pressure so far year to date is just the fact that Jeff Bezos's first wife has been significantly cutting her stake in Amazon, the shares she got in the divorce settlement, where she supposedly cut her stake down something like 40% this past year. A huge cut. And now the stake is only worth around $13 billion is my understanding. So that it might just be as simple as that. You might have all these other concerns, like how come, you're not a front runner in the AI race? Maybe your cash flow is getting eaten up by these capital expenditures. Maybe it's the government squeezing the business. Maybe it's just as simple as that there was a lot of supply in this past year, as one of the indirect founders, you could think, the wife of the founder, Jeff Bezos, is significantly trimming her shares. So let's go back to the core other question. So we've sort of covered an overview of why Amazon stock has been under pressure. I don't think it's really as much fundamentally driven, because we're going to talk about those fundamentals in just a second. So let's review, is Amazon stock on sale? And so when you think about Amazon, it is important to recognize that Amazon has so many different business lines. You have their online stores, you have their physical stores like Whole Foods, you have third-party services like fulfillment for third-party merchants, you have advertising revenue, subscription services like Prime, you have AWS, you have other is becoming increasingly relevant as they consider things like healthcare. And so when you're thinking about this, each of these business lines also have very different profit attributes, and that's what makes it harder to value something like Amazon. For example, their physical stores, it's really hard to get some sort of edge where you're saying, yeah, this should be a 10% plus operating margin business. It probably won't be. A lot of grocery stores, you're probably talking about 3-5% at most. You're not talking about a 20% operating margin. You're talking about a 30% gross margin basis, for these types of businesses. For advertising, however, advertising is a beautiful business for Amazon, and that, based on looking at how other companies, operate, that is likely a very high margin driver for this business. You're talking about, probably 40% plus operating margins for something like advertising, maybe even more. And so that, could significantly influence how you think about this business. So there's a lot of different line items, subscription services. You might think, well, wait a second, that requires the logistics to get the truck, to deliver the package. And the service just keeps getting better in my experience, where it's gone from next day to same day. Incredibly impressive. But the subscription, it's like, okay, well, is this a profit driver for them? Or is this just sort of going to profit neutral? Or, if you're leveraging, video content, will that actually result in better profitability? So there's a lot of moving pieces here. I think the way to think about it actually is to break it down into the individual segments. And that's arguably what management focuses on, because they don't show you the profit per business line. They show you the different segments. And you can see North America is actually doing quite well. Most recent quarter, around 11% revenue growth and near record operating margins of around 7%. This is one that's really been a wake-up call for me personally, because previously it was tough for me to really underwrite that their core North American operations, including online, physical, fulfillment services, third party, all that's baked into North America. I really hadn't seen signs that this could be, let's say, a much higher operating margin business. I mean, you zoom back far enough and there were articles talking about, Amazon blowing up. So this is, I think, proof positive that this business, their core retail business, can be very lucrative. And you can see that it's doing about $20 billion in operating profit per quarter. But most critical is this idea that maybe this could be around 7, 8, 10, maybe even more operating margin, especially as their advertising business scales. So I think this is something to think about. And this is a very clear positive development, seeing this margin going from 5% to 7% in the most recent quarter. And that, frankly, did impact how I think about valuing Amazon. Next up is international. International, frankly, hasn't been great, in my opinion, growing only around the same growth rate as North America, which does reflect, in my opinion, that they're likely losing market share to the local players. And if that's happening, do you really want to keep putting more capital after this? So that creates a whole separate argument of maybe Amazon should, think about selling their operations to international players. People will disagree about that, but it just makes me wonder, after so many years in the international arena, to only be posting growth rates that are comparable to North America, and, they're not anywhere near the same sort of profitability. It just makes me wonder.
This credit card has an interest rate that's really, really low. How low? This low. The credit card that's in your wallet right now probably has an interest rate that's really, really high. How high? This high. And it's that high because a credit card is what's called an unsecured line of credit. Unsecured means risky. They'll approve you quickly, but they'll have to assume you're risky, which means high interest rate, which means more expensive, which means less money in your pocket, which means you get it.
Okay.
No way around it. So why is this card different? Why is the interest rate so much lower? Because Avon came up with a whole new approach. Avon figured out how to give you a secured line of credit based on something you already have. Something that shows you're smart with your money. That's right, your home. The thing that proves you're trustworthy, the thing you already have equity in. Avon uses that equity to approve you for their credit card fast. How fast? this fast. And they did it by reinventing home equity with technology. Unlike loans of the past, you don't need a lot of home equity to qualify for AVEN. You can get approved in minutes instead of weeks. And you can do it all on your phone. No hidden fees, no origination fees, no closing costs, no minimum withdrawals. Just transfer all the balances.
Thinking about it, you could say that, hey, they're just going to keep pushing on delivering. And you could even argue that they have some sort of advantage in doing it because, hey, why don't they take the profits from their North American segment and they could just subsidize international growth, and they don't care about running those profitably if they want, and they can possibly take market share even faster. That would be one theory, but so far, I would say international is probably losing market share relative to local players that are growing much faster. One of my top positions is an international e-commerce player, actually a couple of them. And, they're just growing much faster. They oftentimes do see Amazon as competitors, but it's just not, they don't have the local on the ground experience services offerings that is winning market share. And you're also seeing it, the sort of suboptimal margins. Amazon Web Services, or AWS, this is doing very well, possibly losing market share, growing only around 17% when the market itself might be growing closer to 20% plus. I've also been impressed with how their profitability has improved so significantly, from 30% margins to 37%. So this is, it makes me wonder how sustainable this is, how much of this is based on just sort of accounting for how long their servers will last, those sort of questions. But overall, this is their most lucrative segment. It's still growing well above their other segments. So clearly AWS is a lot of value for when you're thinking about Amazon. But is Amazon actually undervalued? And before we dig into that, specific, showing you my frameworks, first of all, none of this is financial advice. Also, super quick plug. Last week, Joe R. shared, Daniel, thank you for all your insight. I've made almost $1 million following along with your investing journey. This follows San C, who wrote, I initially signed up for the light subscription to test the waters. Since then, your analysis and insights have provided so much amazing value. I've regretted not going all in from the beginning. He's talking about the premium subscription. We have a new community with the Unrivaled Investing Premium subscription. Prices are going to be going up later this month, so now is the time to lock it in. And so when I think about Amazon, I think it is important to reflect this is a business. And if you haven't read all of Jeff Bezos's letters, and he has this wonderful book over my shoulder, Invent and Wander, which is a collection of his annual letters and speeches. It's very, it's thought-provoking and makes you think they deserve to win, and there's a reason why they won. And it's also helpful as you think about, other businesses that you may want to invest in. So I think it's important to say this is a company that's going to keep on making bets where they see huge opportunities, and they're just going to try, and they're going to fail a lot, but they're going to try to, unlock huge new opportunities. One of which I think you could argue is getting into the healthcare space, where you can see, they're moving into not only providing healthcare services, and they're talking about pay-per-visit healthcare for kids 2 to 11. This is using the Amazon One medical plan, but they're also looking to get, into the pharmacy space. Unclear whether or not this has the potential or will disrupt what is otherwise a huge market. U.S. healthcare as a percentage of GDP is something like 20%. It's 1/5 of the U.S. economy. So that is just huge. And so no wonder Amazon's thinking about, hey, how can we break this? How can we disrupt this? Historically, Jeff Bezos has sort of a saying, at least it's attributed to him, of, your margin is my opportunity. Maybe they'll figure that out. And with AI, which Jeff Bezos literally has been talking about for the better part of this past decade, I think there's a good chance they do figure out a way to bring healthcare costs dramatically lower in the years ahead. And maybe that could be a growth driver for Amazon in the years to come. Another key aspect for investors to think about is their advertising business just is doing very well and arguably has years and years of growth ahead of it, especially as, you're thinking about Prime getting more and more content. Maybe it's getting live sports. Maybe it's getting more movies. Maybe it's using AI to generate content. It's going to become even cheaper to create more movies. And so you're going to say, hey, this custom catalog built just for me that Amazon knows based on my viewing and my shopping, here it is. We just made this for you. We know you just bought, cat food. Maybe you're going to be interested in these videos. Who knows? Maybe you even create that content. So I think, the runway for their advertising business, this is one of their faster growers, continues to post, strong numbers. Another prospect is that, they reboot Alexa. This is definitely a lead that I'd argue they've given up, and maybe there's some sort of push in robotics. Who knows how that plays out? So as we think about the different segments, this is hypothetical. Of course, stock price can go higher or lower, but I want to build into I want to think about the different pieces. And so we have North America. North America is arguably worth somewhere between 1/3 to 100% of the current market cap. Thinking about how we look at these different pieces. The big change with this video is thinking about how North American margins could be long term. And just based on how much they've been able to improve this past year, I think it is important to reset my expectations, which were previously a little bit lower, to closer to 8 to 12% over time. Currently, it's around 7%. Most recent quarter was around 7.5%. So I do think that that trajectory might suggest that their margins long term might be around 10%. Give or take. So then the question is, well, what's the growth rate in the years ahead? This is, they've become so big that they are tied to the U.S. economy. So if there is a bit of a recession, I would expect lower growth rates, maybe even a contraction. However, it is a very valuable business and a lot of consumers love it. So I think, a fair market value, I think, seems very reasonable. The market's currently trading around 25 times, assuming a similar multiple for Amazon's North America segment seems appropriate as well. AWS, I do factor in international in the summary sheet, which you'll see in just a second, but it's so small relative to North America and AWS. We'll just skip it for now. But AWS, arguably worth more than half of the current market cap and possibly worth over 100% of the current market cap. And the question is, well, what's the long-term margins? Because margins have improved a lot significantly, have improved significantly this past year from around 30 to 36, 37%. So the question is this going to stay at that rate? Are they not accounting for their server depreciation at an appropriate rate, because of all this CapEx that they're having to do? And, I'm thinking that roughly it continues growing at a teens rate. Maybe I'm being a little too conservative here. I'm assuming a slightly higher valuation for AWS 5 years out.
Hey, Lance Ippolito here, obsessive stock market trader and creator of the Master Indicator. Can I tell you something most people don't realize about the stock market? There's actually tons of great trades out there every day. In fact, if you click the Learn How button on this video, I have an entire presentation showing you how to find more opportunities in the stock market than you probably ever realized were available to mainstream investors. You gotta ignore these self-proclaimed experts who say you have to be patient to find a good trade. Or they act like there's only 1 or 2 good stocks out of 5,000 worth trading. That's ridiculous. Honestly, do you think these massive hedge funds have 100 guys on the floor all waiting for some silly setup that happens once a week? Well, I was one of those guys, and I can tell you the answer is absolutely not. They are trading a ton of action every day because stuff is moving every day. Just regular investors don't have a way to see those massive opportunities, and that's why I built the Master Indicator. I usually find at least 5, sometimes even 10 great opportunities every day with the Master Indicator, and I don't mean staring at charts all day. I mean, around 3:30 p.m. before the market closes, I can pop open my screens and usually find multiple great trades in under 10 minutes. And the rest of the time, I could be out here, out on my garden, out on the boat. See, my situation is really simple. I need opportunities if I want a chance to profit from the stock market. But I'm not willing to be tied to the computer all day. That's why I left the world of investment banking in the first place, and the Master Indicator allows me to have the best of both worlds. I have plenty of high-quality trades to choose from, and yet I can spend very little time searching for these trades. Click the button at the bottom of the video and I'll show you how it all works. Now, just to be clear, I'm not saying every trade out there will be a winner. When you trade as much as I do, you take your share of losses. That's part of the game. But I can usually isolate 5 or more high caliber opportunities every time I load up the Master Indicator and take a look. Most people wouldn't know a good trade if the chart popped up on the screen and smacked them in the face, because most people are used to hearing about some hot stock tip. That doesn't make any sense. But if you have a way to get these signals based on what's really happening behind the scenes with stocks, there's a ton of them moving every day. Like just recently, when AI stocks got all the hot buzz, the Master Indicator was all over them. Check out this up arrow that printed on a little-known C3 AI stock the day before the massive jump. That's a 27% move on the stock. 24 hours. That same week, the master indicator identified 10
So putting all the pieces together, based on where the stock price trades today, you're around $2.3 trillion market cap. Think about their North American operations, think about AWS, think about international. International, once again, the smallest piece of the three core segments. And you're effectively looking at, once again, hypothetical stock prices can, you can have macro events that dramatically, impact how things happen. Sentiment can change. But looking at this hypothetical framework, I'm roughly saying that over the next 5 years, it wouldn't surprise me in a low case that it actually compounds around 1%. You factor in a couple percent for the cash flow that goes to shareholders each year, as they're expected to keep generating positive free cash flow. And then in a more of a high case, you might even compound closer to 20% plus over the next 5 years, closer to, 100, 200% type of upside. So I actually am of the mind that as I look at Amazon now, that it is arguably undervalued. And I do like that asymmetry of like, over the next 5 years, maybe if it's, slightly better than break even, possibly, and maybe over, the upside, maybe it's closer to 100, 200%. Those are the types of bets I like to make. And it's no surprise to see, major investors like Bill Ackman say, maybe I want to own Amazon because they have these big funds and they're trying to find setups like this. Now, personally, as a smaller investor, I can find, smaller than something like a Bill Ackman, I can find plays that are, let's say, $3 billion market caps and have much faster growth and better risk rewards. And literally just earlier today, I was calling out to my subscribers at Unrivaled Investing, a company where the framework's closer to, 40, 50, 60% upside on the low case, using what I think are conservative and reasonable assumptions, and closer to 300% upside or maybe more on the high. So anywho, I think every investor needs to figure out what they want to own, what are the risks that they're comfortable with. But for those investors that want to stick to the mega caps, the $2 trillion types of names, wouldn't surprise me if Amazon actually does quite well or very reasonably over the next 5 years, even though so far 2025, it's been struggling and it's been slightly underwater. I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.
We hit the point where literally anybody can build a fully working app without knowing how to code. This is Base 44. This is a first look at the current industry-leading AI app builder, and you wouldn't believe the kind of apps that people are creating. Smart nutrition apps, inventory trackers, onboarding tools, you name it. And if the only thing stopping me from making the app is the idea, then why not build an app that gives me endless app ideas? So let's make it. Pro tip, I draft the full app spec in ChatGPT, and then I drop the prompt directly into Base 44. It gives me super detailed structure. And here it is. Everything I laid out in detail as it goes. This is pretty awesome, but I want to make it playful. So I'm going to add a swipe left and swipe right interface. The same usability we all know. Now I'm going to add one more feature. So every idea that I favorite will turn into a kickoff prompt to start building the app itself. And that's it. Just come up with your idea, any idea, and Base 44 will do the rest. So go to Base 44 and create apps with your name on it.
Is Amazon stock a buy heading into 2026? In this webinar replay, you'll see exactly how we researched Amazon stock from scratch. You'll see us break down the company's business model, moat, growth potential, key metrics, risks, and valuation, all in real time. Stick around to the end for a full audience Q&A and our final take on whether Amazon deserves a spot in your portfolio. Okay, so how are we going to research this stock from scratch? We are going to use the stock simplifier format. So here is the cheat sheet that we are going to use. There's essentially 7 steps to researching a stock from scratch. Now we're going to go fairly quickly through this, and we're going to use the AI prompts that we built to do it. Just know if you have questions about any of the details that we have, if you do buy Stock Simplifier, it comes with a full course explaining everything. It comes with a tool we're going to use. It comes with the prompts we're going to use. So all of this is built into Stock Simplifier. But Brian, question number 1 in Stock Simplifier is this. What is this?
Yeah, so this is the business growth cycle. I think it's probably the one thing that we've kind of proselytized that really kind of changes the way that people understand the stocks that they're looking at. It's the business growth cycle.
Yep. So the business growth cycle, there are 6 distinct stages that publicly traded companies, or really all companies, go through in their life. And figuring out which stage a company is in is critical to doing the analysis on it. So we have a prompt that we're going to run to get this done. But let's go ahead and just ask people right now, which phase do they think Amazon is in? So before we run the prompt, let's do a poll of the audience. Which of these 6 phases do you think Amazon is in if you know Amazon's business right now? So is it phase 1, phase 2, phase 3, phase 4, phase 5, or phase 6?
Yep. And we've got the answers rolling in here. We've already, Brian, in 13 seconds, we had half of our hundreds and hundreds of participants already respond, which is awesome. I'm going to give it just 10 more seconds here. I will say Amazon's a little bit of a tough one because it's got so many different parts of its business, and some parts are in this phase, some parts are in that phase. But that was 30 seconds. 3/4 of the people that are watching responded, and 54% said it was in the operating leverage, stage 4. 38% said stage 5. So the bulk of ours either said stage 4 or stage 5.
Okay, great. So people are saying stage 4 or stage 5. So how do we figure out the stages? Well, we have to pay attention to revenue growth, operating profit, and the capital return program. Now, each of those numbers do correlate with a specific metric on the income statement. So we can use the income statement to figure that out. So I'm in Stock Simplifier here, and here's the all course materials. And I'm actually going to open up a fresh copy of the spreadsheet here that we use just to show you how you can use the tool here to figure out this fundamental question to the business. So if we go over to phase analysis, I'm going to type in the ticker symbol here, Amazon. It's a $2.4 billion company. And let me zoom in a little bit just so people can see a little easier. So you can select the revenue growth targets here and the operating target. And this will actually is a little tool that we can use to figure this out. But I'm actually going to use one of the AI prompts to do this. So here's our database of AI prompts. We're going to do the phase analysis, and we're going to see if ChatGPT, what kind of job ChatGPT does here. So
Brian, I know we're going to get questions on this, so I'm just going to go ahead and ask it right off the bat. Is that the only LLM, large language model, that we can use?
You can use, we've designed them to use all of them. I've found that you get pretty consistent results with ChatGPT. I tried it with Gemini. Gemini gave pretty good results. It was a little slower and it didn't have links to there, but we're going to use ChatGPT since this is the most popular LLM out there for this analysis. But we designed this prompt. It's a prompt, so you can use it with any LLM. So all I did is I copied this prompt here. It's almost 2,000 words long. And I'm going to paste it in there. And if ChatGPT is doing its job correctly, it's going to say, great, what company would you like me to analyze? And I'll zoom in here a little bit. And I'm going to say Amazon, AMZN. And this might take a couple of seconds for it to figure it out. We have programmed this prompt to use the company's annual report so that's going to be the 2024 annual report and the most recent quarterly report to figure this out. So ChatGPT says phase 4, operating leverage.
It agrees with us.
It has a high confidence in that. So with any AI, you should say, prove it. Where did you come up with that information from? We don't like hallucination. So it says operating income was positive, $68.6 billion, up from 36 the year before. And there's a link right here.
Oh, look at that.
To the SEC filing. So if I click that, this should have the 10K from the year ending 2024. And I'm just going to do a quick search to see if it comes up with that. 68.
Thinking about going solar, but not sure whether it's worth it for your home? Well, before you get quotes, there are 3 things you need to know about going solar and one easy way to find them out. Number 1, you need to know how much solar you'll need to eliminate your electricity bill completely. 2, you need to know how much solar you can actually fit on your roof. And 3, you need to know what the ideal solar system will cost after federal, state, and utility incentives. In the past, to find out all this information, you had to get a solar installer in your area to examine your roof in person, but not anymore. Our unique solar calculator at solarestimate.org uses machine learning to scan your roof to tell you whether solar is worth it for your home. It will tell you how much electricity your roof can generate, how many solar panels you can actually fit on your roof, how much you can reduce your monthly electricity bill with solar based on your utilities pricing plan, and the magic number every homeowner wants to know: how long will it take for the system to pay for itself? No other solar calculator does all this. Now, if the payback on solar is better than other low-risk options like paying off your mortgage, then solar makes a lot of sense. The typical payback time for solar is under 10 years, making it a no-brainer given the historically low interest rates we have at the moment. So to find out if solar is worth it, test your home with America's most accurate solar calculator by clicking on the link below. Now, you may already know that solar is worth it and just want to find out how much solar will cost after all the incentives. Well, the reason our estimates are so accurate is because we use the actual cost of installation from thousands of similar solar systems near you to hone our estimates. Using this data, we found the best solar deals being offered from reputable installers we vetted using over 28,000 verified reviews from actual customers. To get access to these deals, simply select how many installers you would like firm quotes from after the calculator finishes analyzing your home. If you're not ready to get quoted just yet, you can still get a detailed solar analysis, including cost estimates for your home to keep for you when you're ready. Stop paying full price for electricity and start taking advantage of the generous incentives available for solar by clicking on this video or the link below and getting a free, no obligation solar analysis for your home.
What if employer-sponsored insurance didn't have to be group insurance? Group health plans often come with rising costs. And more importantly, healthcare isn't a group decision. It's personal. Even with the buying power of an entire business, group insurance can still mean high costs and limited choices. That puts businesses in a tough position and leaves employees with plan options that might not be the best fit for them. Or worse, no options at all. Now, a new form of employer coverage can help. ICHRAs offer the kind of control businesses and employees need. They make costs predictable, thanks to a much larger risk pool and stable employer contributions. They make plans personal, because employees can buy any plan that fits their needs from any carrier on the marketplace. And they make coverage possible, because ICHRAs means some businesses can now afford to offer insurance for the first time. So what exactly is an ICHRA? ICHRA stands for Individual Coverage Health Reimbursement Arrangements, and it means that businesses can reimburse each employee for the health plan of their choice pre-tax. Instead of picking from just 2 or 3 group options, ICHRAs provide funds for employees to spend on any plan they'd like. You choose how much to contribute, they choose what works for them. So if premium increases are a surprise each year and one size doesn't fit all, plan on predictable. Plan on personal. Plan on an ICHRA. Get coverage you control. Find out if an ICHRA is right for you.
68.5. Look at that.
Hey, you got it right.
Operating
Way to
income,
go.
68 and 36. So ChatGPT, how can we trust this number? Because the source is right there, the primary
Brian,
source.
I want to point out one other thing real quick. I love how it picked this because revenue growth is 11%, and I can't do the math of going from 37 billion to 69 billion, but I know that's way faster than 11%, and that is the key sign for stage 4.
Absolutely. And there's no meaningful dividend or large buyback. So the company isn't returning capital to shareholders, at least meaningfully.
Well,
So
yeah, I like that meaningful too, because it kind of says, you know, if there was a little bit, that wouldn't really matter that much. So I like that.
Yep. So let's tuck this in our back pocket for later. So in phase 4, the most useful valuation metrics are forward price to earnings and forward price to free cash flow. Why? Because the company demonstrates scalable profitability, and forward earnings reflect the trajectory of profitability, and we should avoid price to sales, price to gross profit, price to book, liquidation, and asset-based valuation, and there are some links. So I would say We've done a pretty good job on there. And I would agree with that analysis.
I would agree with it too. I think in the end, that's the point too. Like you can test this out on companies, you and I have owned this stock for decades. So I agree.
So I'm going to go ahead and just click this phase 4 button here. And what that'll do in our spreadsheet is it'll actually update these to be based on what analysis we should do for a phase 4 for company. So that's how that works there. All right. Question 1 out of the way. Question 2, what does this company do? I bet people have an idea of what it does, but I bet they don't know the details of what that it does. So we're trying to figure out, after we read through the 10K, is this red, I'm confused, yellow, I understand, or green, I'm excited? Now, there are 7 key questions that we ask with any business. How does it make money? What are its key products and services? So 4 are just, what does it do? And 3 are qualitative in nature. So this is where AI can once again help us. Here is the business analysis prompt. I'm going to copy this prompt. I'm going to go over to ChatGPT. I'm going to paste it in.
And while you do that, I just want to answer Omar's question. Said, can I use Copilot? Yes, you can absolutely give it a try.
I've never used Copilot. I don't have access to Copilot, so I'd love to know if these prompts work on Copilot. We've tried all the major ones, but I haven't tried Copilot, which I believe is powered by ChatGPT.
I'm not sure.
It's Microsoft.
I assume since they have the partnership between Microsoft and OpenAI.
Yeah. Okay. So here we got using Amazon's most recent annual report, very key information, and the Q1 of 2025 10Q. What does it do? Amazon operates a global technology and retail platform. It runs on large online marketplaces, a cloud division, AWS, a portfolio of digital services, Prime Video, Alexa, and advertising. The company also designs and sells consumer electronics like Kindle, Echo, and Fire TV. Pretty good.
I haven't thought of Fire TV in a long time.
Yep. Pretty good. I would say that that's spot on. And I'll zoom in a little bit more.
I tell you what, this next part, the how it makes money, the bullet points, I think that is the most valuable.
Totally. So how does it make money? Amazon earns revenue from retail sales, third-party services, cloud computing, advertising, and subscriptions. So online stores were $229 billion, 36% through Amazon-owned websites. Third-party sellers was $160 billion. Fees and fulfillment revenue from independent merchants. Amazon Web Services was $106 billion, 17% of revenue. Advertising is 9% of revenue, $57 billion.
Yep.
Of Amazon's revenue is high margin advertising. Subscription services was $48 billion, and other is $38 billion, or 5%. And this is from the company's 10K item 7 segmented results.
Hey.
Who are the customers? Consumers, third-party sellers, enterprises, startups and governments, and advertisers. Spot on. Where does it operate? North America is 68% of sales, international is 17%, and AWS is 15% of sales, and I think that equals 100.
Yeah, well, and the other thing to point out though too is that the international is likely higher because a portion of that AWS, what they mean by international there is like international e-commerce.
Sure. Yep, that's a good color. Okay. So that's the what it does. Now comes times for the more qualitative, is this a good business? So how often do customers buy? Highly recurring activity. Retail customers purchase multiple times per month, especially Prime members. That's true in my household.
Yeah, every day.
Something from Amazon this morning.
Yep, same.
Amazon clients operate under long-term usage contracts that automatically renew. Prime subscriptions renew annually or monthly, and this recurring usage drives consistent cash flow. Totally agree with that analysis.
Yep.
Can it raise prices? Yes, selectively. Amazon raised Prime membership fees in 2022.
They didn't lose me.
Amazon Web Services introduced new higher margin services that offset pricing pressure, and gross margin has risen to 47%, up from 43% the year before, showing pricing and mix improvements. Excellent sign of pricing power.
If you ever get a chance, you should pull up Amazon's gross margins over the last 20 years.
We can do that.
One of the most remarkable things I've ever seen.
Final question is what happens in a recession? So retail discretionary slows, but essential subscription stabilizes revenue. AWS usage may moderate, but remains mission critical. And advertising is sensitive. So advertising, I would say, is the most sensitive
Absolutely.
to revenue. So operating income declined by 50% in 2022, but then it rebounded. And there are all of the primary sources that
With
have
links.
been used. So you just brought up a good point. So I am going to actually go here and let's click over to fiscal.ai. And I am going to search up Amazon. So here's Amazon on fiscal.ai. And you said, let's take a look at this company's long-term gross margin. So financials and gross profit margin is right here.
Looking for an easier way to get that LLC next to your business name? Say hello to Taylor Brands. Just go to their site, enter your LLC state, choose your business name, answer a few questions, and that's it. Now your business has tax flexibility and personal asset protection. Plus, it's approved by the state. And it took you what, 3 minutes?
As business owners, we can't waste any time. That's the advantage of using Taylor Brands. They get you your time back.
Taylor Brands handles everything from forming an LLC, your EIN, opening a business bank account, taxes and bookkeeping, your registered agent, and more. As a business builder.
All in one platform for the business owners.
Search for Taylor Brands
and start your business journey today.
The stock market is open for nearly 7 hours a day, but don't even think about trading it after.
Look at that.
Their gross margin used to be 22%. Now it's 49.6%.
I've never seen something like that happen over 15 years.
That is unbelievable. You thought this was going to be a low margin business forever, and Amazon. So let's make sure we're on the same page. This means for every dollar in sales, how many pennies become gross profit? So it used to be 22 pennies. Now it's almost 50 pennies. Incredible improvements. Incredible. Now, one other cool thing we can do on with Fiscal is if we go to segments and KPIs, let's pull up each of their individual components here, and we can actually see how fast each of the individual components are growing. So all I'm going to do is I'm going to click over and I'm going to put each of these components on.
If you're wondering what the physical stores are, those are mostly their Whole Foods.
So there's the physical components, but if I push this button right here, this will actually stack them up. And so here we can see.
I love that view.
How, let's just do a 5-year view. I'm going to scroll this to be 5 years. Make it a little bit more obvious. Okay, so here's how each segment has grown. So this is online stores, and you can see that CAGR. So this business is growing 6% per year.
So that's probably like a stage 5 business.
Totally. That's Walmart.
Yep.
Right? This one is third-party revenue. So this is from fees from third-party sellers, 17% compound annual growth.
Mm-hmm. Much
Next,
faster.
Amazon Web Services, 23% growth.
Mm-hmm.
Advertising, 29% growth. Subscription revenue, so Prime and stuff, 15% growth. And physical stores, 7% growth. So it's cool that with this, you can actually break down and see each of the components individually.
I agree.
So cool. All right, so going through this, we know how it makes money. We know it's key products. We know that it's a recurring business. We know that the company can probably increase prices. And in a recession, I would say normal.
Yeah, I mean,
some recession proofness to it.
Some recession proof, some that advertising is highly sensitive, but it is a smaller piece of the pie.
Yep. So let's do a poll here. What do you guys think of Amazon, the business? Is this an attractive business? Red, not at all. Or no. Yellow, kind of. Green, yes, it's a very attractive business.
Yeah. And while we're doing this, just want to remind everyone, we will be sending out an email with a link to a replay of this in the next 24 hours. So
yeah, actually, while that's happening, if you're watching, if you want Stock Simplifier, if you want everything that we're using to analyze this, the AI prompts, the cheat sheet, the checklist, all that kind of stuff, Stock Simplifier is normally $199, but Stoffel will share a link in the chat that you guys can get it for $99. So if you could share that in the chat, that would be
shared it, so it's in the chat.
That'd be great.
Right now.
So what is the answer? Do people think this is an attractive business?
Yes, 91% of people said that this is an attractive business. So
I totally agree with that analysis. All right, up next, moat. Does Amazon have a moat? So 3 categories of moat, broadly speaking: none, or it's getting worse; narrow, and it's stable; or wide, and it's expanding. And there's, of course, shades of gray in between each of those, but there are, largely speaking, 5 different sources of a moat. There's 3 different directions of the moat. The current state of the moat is either none, narrow, or wide. And then I would say, perhaps most importantly,
I think for investing, it's most important, right?
Direction.
Because the moves in the stock honestly have more to do with the direction than anything else.
I have no interest in a wide moat that's shrinking. I am interested in no moat that's widening, or narrow moat that's widening.
Yes.
So let's, before we do the AI prompt, we'd love to know what people think. What is Amazon's primary moat? Number 1 moat source, most important moat. What would you say? Which of the 5 moats do you think is the most powerful moat that Amazon has?
Brian, I would say that of all the publicly traded companies that we could do this on, this to me is the most difficult one.
Sure.
I know what my opinion on this is, and I'll give it as soon as we close the polls. Let's give it like another 30 seconds. But I think that a very good argument could be made for all 5 of these.
I totally agree. I totally agree. If you, again, we're asking for the primary, and I don't think there's a wrong answer.
No.
But I can tell you how I would answer it. So, and I would love to hear how you answer it. All right. So what does the audience say?
Yep. So here's what the audience says. 52% said network effect.
Okay.
And then in the teens, we have switching costs and low cost production.
Okay.
So what I would say is I think they're all there. I think the strongest moat, personally, I believe, is low cost production. And here's why. I think the hardest thing for anyone to match, that would just be almost impossible to match quickly, is Amazon's ability to have a package delivered to your front door tomorrow at a lower internal cost. I don't think anyone can deliver that package to your front door tomorrow at a lower internal cost than Amazon. And that's because of their fulfillment network. To me, that's the strongest one.
If forced to choose, I would say the same thing. And I have a hunch that some people think that same thing, and they put down network effects for the number, for the network of distribution centers.
Sure.
That the company has. But again, I would also say low cost production. That people when they hear low cost, they think low price.
Right.
Completely different things.
I mean, it can mean the same thing sometimes.
Can. Low cost means the internal cost to you, the business, to deliver that thing is lower than competitors, usually because of massive scale.
Yeah.
So Costco, Walmart, right? You could even say United Health Group and Blue Cross Blue Shield, low cost producers, different than low price. Low price is a strategy. Low cost is a moat.
This credit card has an interest rate that's really, really low. How low? This low. The credit card that's in your wallet right now probably has an interest rate that's really, really high. How high? This high. And it's that high because a credit card is what's called an unsecured line of credit. Unsecured means risky. They'll approve you quickly, but they'll have to assume you're
risky,
which means high interest rate, which means more expensive, which means less money in your pocket, which means you get it.
Okay.
No way around it. So why is this card different? Why is the interest rate so much lower? Because Avon came up with a whole new approach. Avon figured out how to give you a secured line of credit based on something you already have. Something that shows you're smart with your money. That's right, your home. The thing that proves you're trustworthy, the thing you already have equity in. Avon uses that equity to approve you for their credit card fast. How fast? This fast. And they did it by reinventing home equity with technology. Unlike loans of the past, you don't need a lot of home equity to qualify for Avon. You can get approved in minutes instead of weeks. And you can do it all on your phone. No hidden fees, no origination fees, no closing costs, no minimum withdrawals. Just transfer all the balances from those other high interest cards. All because of your house, you can get the capital you need, big or small. And always with a rate that's really, really low. Check your offer now at avon.com. AVEN.com.
At Elastic Stage, we've created something totally unique. The world's first on-demand, end-to-end platform for making vinyl and CDs. Our product has made the vinyl market accessible to all artists and labels for the first time. We've developed a patented technology that produces vinyl without the usual long and expensive setup, whilst also improving the audio quality. Artists build their records on our web platform by simply uploading their music without putting money down, without having to place minimum orders, and without taking on any financial risk. We handle everything else from production, packaging, licensing, customer service, and even global shipping to more than 100 countries. We exist to give every artist the possibility of effortlessly and instantly putting a real record in the hands of their fans.
Running a company like Elastic Stage means operating at the intersection of creativity, technology, and logistics. Every single record we make is unique. We might produce thousands of individual records on any given day, shipping to more than 100 countries. And to make that possible, we've come up with the biggest invention in vinyl production in over 100 years without compromising on quality. We had to streamline the printing and finishing processes with new automation levels and develop a workflow that doesn't have warehouses. But speed isn't enough. We're handling people's art, and that demands care. We've built intelligent audio processing tools and automated quality checks to ensure that every disc meets the highest standard. Then there's the behind-the-scenes work, the kind that adds up fast. It's not the glamorous part of the job, but it keeps the business running. And when you're managing thousands of live releases at once, all that admin is a serious drain on time and bandwidth, which in a startup is scarce. We needed a setup that could support real collaboration, reduce manual workload, and keep up with the pace with our business, so we could focus on what really matters, bringing great music to life fast.
That's why we decided to try the Acer TravelMate P6 laptops, and to be honest, it was a real turning point. Here's the cool part. The AI engine works alongside the CPU and GPU to make everything smarter and faster. The way the NPU teams up with the processor and graphics card makes AI tools feel instant. Better resource management, lower energy consumption, and way higher performance compared to previous generations. This Acer TravelMate P6 is not just faster, it's smarter. What really impressed us is how Microsoft 365 Copilot integrates into the tools that we're already using. In Excel, we're now analyzing big chunks of data in minutes rather than hours. In PowerPoint, last-minute decks aren't stressful anymore. Copilot helps pull visuals and layout suggestions that actually make sense. And in Word, we're drafting and summarizing descriptions without starting from scratch every time. Battery life is another big win. Our teams can work all day without even thinking about the charges. And because cloud tools are fully integrated, we can share progress across teams instantly, whether they're in the studio, at home, or halfway across the world.
You'd think switching to a whole new system would be a pain, right? Nope. Our marketing team especially appreciated how easily they could get into the rhythm of using the Acer TravelMate P6 and its AI tools. Things that used to slow them down, like managing file versions or syncing assets across platform, now just happen in the background. The Intel Core Ultra processors can handle heavy tasks like 3D visualizations and high-res ad assets without even breaking a sweat. We've also automated a bunch of those repetitive tasks that nobody really enjoys, like file sorting, and even some stages of quality control, which frees up time for the creative stuff that actually moves the needle.
We work in a market that moves really fast. Clients expect quick turnarounds, high-quality output, and a smooth experience from start to finish. With the Acer TravelMate P6, we know we can keep pace. The speed, the AI features, the battery life, it's all built for the way we work today. And more importantly, it's helping us shape how we work tomorrow. For us, this laptop isn't just a device, it's a creative partner. Looking ahead, we're already exploring new ways to push things even further, experimenting with AI and predictive tools for campaign performance, maybe even smart personalization for vinyl drops. And we know that with Acer, Intel, and Microsoft Tech, we've got the support to do it. So yeah, it's not just about keeping pace anymore, it's about leading the way.
A certainty. Make it certain.
Yep, totally agree.
All right, so let's go ahead and
let's see if it agrees with us, because this is one of those where we could run this prompt like 5 times and we could get a whole bunch of different things.
I think we would. I think we would too. So let's see what it says. All right, moat analysis. Okay, moat size wide, moat direction stable, moat sources switching costs,
okay,
and network effects.
Let's see what they have to say
ChatGPT
about
agrees
that.
with the crowd. Amazon benefits from strong customer lock-in and self-reinforcing network effect via its Prime ecosystem and large marketplace.
I agree with that.
Which supports high returns over cost of capital for many years. For example, the company's retail sales grew 12%, with AWS up 17%, underscoring scale advantages, and there is the source of that. Okay, so let's go one at a time. Switching costs are present and wide, and they're stable. Amazon's users face significant friction in leaving the ecosystem. Buyers are locked into Prime with the fast free shipping.
Totally agree.
Integrated services make switching costly. Also deeply integrated. And then here is some over 250 million Prime members. Where's that source from? Okay, I don't trust that source. Amazon, so revenue is growth. And then a quote, create high switching costs and reinvesting in moat status.
The big thing for me is very simply that if you ever try and get something delivered not on Amazon, you'll experience that difference.
Yep. Intangible assets are present, wide, and they're stable. So the company's brand, net marketplace, and logistics software are considered an advantage. Network effects. So Amazon's marketplace attracts buyers. Buyers attract sellers. Sellers attract buyers. Prime membership feeds into advertising. The network effect is broad and multinational.
Agreed.
Low cost production is present. Ooh, it says narrow.
I don't agree with that.
Yeah. Amazon's scale and logistics, fulfillment, purchasing, and cloud give it cost advantages, but competition from Walmart and Microsoft/Google and rising fulfillment could impose pressure, limiting the moat's durability. Thus, cost advantages exist, but appears less sustainable from 10 plus years without innovation. Speaking of that, have you ever heard of this company? Have you ever heard of Zipline?
The IRS is coming for your crypto gains, but it doesn't have to be that way. With a crypto IRA from iTrust Capital, you can buy and sell your favorite cryptocurrencies with tax advantages. Even better, with a Roth IRA, your gains could be 100% tax-free. No account or storage fees, 5-star US-based client service, and tax benefits. It's the smart, secure, and easy way to buy and sell crypto. Don't let the IRS take your crypto gains. Start a tax-advantaged crypto IRA today at itrustcapital.com.
No.
This is drone delivery technology that just launched in Dallas, Texas, in the US. This could be a threat, a disruptive threat to Amazon.
Well, okay, so here's the thing. I believe that, but I also remember watching a 60 Minutes video on how Amazon was testing this out. It was 15 years ago.
Yep.
So if Amazon has the technology and hasn't done this at scale yet, I just don't think they're going to be beat. Either they're just waiting and they've got a better way of doing it, or somehow it didn't work.
All I'm saying is that technology could potentially disrupt their distribution advantage.
Sure, it could.
It wouldn't negotiate the other advantages, but it could disrupt that. And then finally, counter-positioning. It's actually giving the company credit for counter-positioning because of their cloud, retail. So I think this is versus retail players like Walmart. Although I would say that I wouldn't give them credit for that.
I mean, if this was 10 years ago, I'd give them credit for that.
Yeah. Either way, does Amazon have a moat?
No doubt.
Yes, an extremely wide moat as of right now. Okay, next question. Long-term potential. Why should we believe as shareholders that Amazon can continue to grow over time? There are two ways that companies grow: new customers and getting existing customers to spend more. Now, there are subcategories for how do you get new customers? Well, new distribution, new sales and marketing spending. You go into new markets, you make acquisitions. Amazon's done all of those. How do you get existing customers to spend more? You raise prices, you do new products and services, and you focus on customer retention. Amazon's done all of those.
Yep.
Now, in Stock Simplifier, what we teach you to do is to go to Amazon's page in Fiscal. And if we look at the growth rate right here, we can see that over the next 2 years, analysts believe that revenue is going to grow at a 10% compound annual growth rate, and earnings per share over the long term, so 5 years plus, is going to grow at a 17% compound annual growth rate. And if you have the premium plan, like we do, you can actually click the estimates button, and you can actually see what the analyst estimates are for revenue over a multi-year period and stuff like that. But let's put a poll up.
Yeah.
What do you guys think? Does Amazon, the company, have long-term growth potential? No, it's meager. Yellow, kind of mid-tier, or yes, very high growth potential.
And when this pops up, Brian, this, out of all of the prompts that we've created here, this is my favorite one. And here's the reason why. And y'all will see this when we run it. I love, like reasonable, we'll call them smart cuts, not shortcuts, but smart cuts. If you can identify the 2 or 3 metrics that are really going to drive the growth narrative for a company, someone mentioned Amazon's reporting earnings on the 30th of October. You all of a sudden have a place to go look as soon as they report. And that is incredibly valuable.
Well, this is the story that you get to tell yourself. So
Right.
when Amazon stocks drops, this is the story of why you should still have conviction.
And I'll say,
essentially,
these folks think it does. 77% said, yes, it does have growth potential. 22% said kind of. We only had one person out of the hundreds and hundreds here who said no.
all right. So I so here's the long-term potential prompt. I put it in there. What company would you like me to analyze? Amazon, AMZN. And we'll see what ChatGPT says. So using its 10K. Okay. New customer acquisition. So marketing and sales investment. This is a moderate area of growth. The company states that sales and marketing costs did not significantly change, so it's not investing a ton in that. Okay. New distribution channels, strong. Sales growth was driven by increasing using sales, third-party sellers, advertising, and subscription services.
I think what that means just is that it's what we saw when we broke it down by steps. It's like advertising and AWS, that's new distribution, quote
Yes,
unquote.
that's what it's giving as a new distribution channel. Yep. Geographic expansion strong. Net sales increased 12% internationally and 10% for the 9-month. High confidence. Acquisitions, weak. I found no major recent acquisitions disclosure that clearly signal large bolt-on growth drivers, although it has low confidence. I would say that that's accurate.
Yeah. I mean, they've made important ones, but that's more about cutting costs in their warehouses than it is about sales growth.
Yeah, I mean, Amazon is like what, like a $2 trillion company or something?
Mhm.
2.4. So even if it bought a $200 billion company, that would be 10% of the company's size. Yeah. All right, next. Existing customer expansion, moderate pricing power, operating margin improved, indicating some pricing or cost leverage. New products or services, strong. The company indicated that AWS grew 19%, pointing to new cloud services. I'd also add in there the advertising business is at significant scale. Customer retention is moderate. Unearned revenue was $20 billion. So biggest growth drivers are geographic and market expansion and new product and services. Secondary are distribution channels, pricing, and customer retention. Untapped are acquisitions. I'm going to say that the company doesn't really have acquisitions as an outlet. And then here's a nice color-coded map for you at the bottom.
Brian, real quick, do you still have that Fiscal AI page for Amazon pulled up where we had their KPIs?
No, but I can get it.
Okay, well, you don't even need, so
it does, yeah.
What I think is really, really great about this prompt is now, I already knew this, but if I didn't, when I go and look at Amazon, I'm obviously, because this is what I do for my job, I'm going to read the whole report. But the first place that I'm going to go is the new products and services. So I'm going to look at third-party seller services, AWS, and advertising. And I'm going to say, how much did those three things grow? Because that will probably account for a huge part of how the stock reacts. And then the other part, if you just scroll down where they have international, I'm just going to look at how much did their international grow. So I know that's in segments and KPIs. Yeah. So there you go, international revenue. And I'll just look at that. And so the great thing about this prompt is that now I've got 4 tailored metrics that I'm going to look for this investment.
Yeah. So the answer there is international is growing, but it's
not knocking the ball out of the park.
It's not a major driver.
Right.
Right. I mean, it's essentially grown 40% in the last 5 years total. So what's that? 8% per year. It's not nothing.
But I think a lot of people think that that operating income is really important too, because it's profitable now. And you see that it's increasing somewhat rapidly. I think there's a lot of hope that it can become a driver.
Yeah.
Whether it does, I don't know.
Yeah. Yeah, for sure.
Thinking about going solar, but not sure whether it's worth it for your home? Well, before you get quotes, there are 3 things you need to know about going solar and one easy way to find them out. Number 1. You need to know how much solar you'll need to eliminate your electricity bill completely. 2. You need to know how much solar you can actually fit on your roof. And 3. You need to know what the ideal solar system will cost after federal, state.
Okay. Okay. As a reminder, if you want everything that we're using, $99 for Stock Simplifier if you use the link that's in the chat.
And
okay,
I'm putting it back in the chat right now, Brian. Real quick, we had one question about it.
Sure.
Is that just for 1 year?
Yeah. No, it's a one-time. It's one time. There's no recurring payment at all. It's a one-time fee.
And if we discover better ways to write the prompts, will people have access to that?
Yes. As we create new prompts and new methods, we're going to update them in Stock Simplifier, and you'll get access to any additional things that we create, any additional prompts. You'll get those included. So it's a one-time payment that gets you that. Yeah.
Okay. Cool.
Just to make sure that was clear. Okay. Next, key metrics for a phase 4 company. So again, if we use the tool, the checklist tool, these metrics do change depending on which phase the company is in, hence why we did the phase first. Here are the key metrics to look at for a phase 4 company. So Amazon, we identified as phase 4. So revenue growth on a 3-year basis, operating margin, free cash flow margin, earnings versus estimates, and ROIC. I wonder if this, well, we'll see. How good of a job is ChatGPT going to do with looking up all of those metrics in there? So it should ask us what company and what phase is it in. Yep. Okay. So Amazon.
In phase 4?
Phase 4.
Okay.
We are asking ChatGPT to do detailed calculations into the metrics and the margins and stuff like that. So if you've ever used AI, you know that it doesn't always do the best. It's simple math. But we'll see what it says. And I do have fiscal.ai here to just back it up.
Yeah. All so right. you can see right here where it calculated it, but its color coding doesn't make sense. So if the threshold was 20% plus and it's telling us that it's growing at 11%, well, that should be yellow, for instance.
Yep. And if we go here, so if we go back to AWS. So over the last 3 years, revenue has grown 11.3%. So that is correct. Mm-hmm. But our target is 20%. So this should be a yellow from a growth rate. Okay. Operating margin, this is saying 10.8%, and that's green because it's a positive figure and it's rising. Mm-hmm. Free cash flow margin was 36 billion on that much revenue. So 6%. So it is a positive number. I have a feeling this number is
all over the place.
Yeah, because of the huge CapEx spending. Earnings versus estimates. 4 of the 4 recent quarters include beats on guidance, and it's using Amazon as a result there. So that's really good. And then return on invested capital, it's saying 13.3%, and that's above 5% and rising. I wonder if that's accurate. So this is saying 6, but that's on a 5-year basis. So if I go financials, and then I go down, and this should be under ratios, and then so many ratios, so many numbers. If we go to, I think it's capital efficiency, return on invested capital, this is saying, yeah, you can see that's all over the map.
Yeah.
Return on invested capital, 12.7%.
So it's pretty close.
Yeah, it is. It is pretty close. So
real quick question. That ROIC target of above 5%. Tarun is just wondering, how do we pick that? And isn't that highly industry dependent?
Yes, it's definitely industry dependent. For Stock Simplifier, we simplified things as much as possible. And note that 5% is not like a really strong number in absolute terms. Keep in mind that this is a phase 4 company, not a phase 5. It's a phase 4. So its profitability is improving. So we wanted this number just to be a positive figure and trending upward. That is more important to us than the absolute number is at this phase. If it was a phase 5 company, we would want this number to be in the double digits. Yep. All right. But overall, I would say that this is a yellow, this is a green, this is a yellow, this is a green, and this is a green. So 3 of the 5, it's done pretty good.
Not bad.
On a key metric perspective, I would say green/yellowish, depending on the exact metric.
Agreed.
Let's pause for questions. Do we have any questions we have?
Sarvan was wondering, can we use Stock Simplifier for small or medium size, like small cap, medium size, medium, mid cap?
Yes. Stock Simplifier is great for overall views. There are a couple of industries where it does not perform that well. Any really cyclical industries, so oil companies, biotech companies, like companies that lose tons of money on purpose, it doesn't work well. Any companies with really heavy cyclical demand, it doesn't work as well on. Banks and insurance companies, like financial institutions, it doesn't work as well on. So we like to say it gets you, it covers 80% of the market, not 100%, but 80%. But even the basic things that we're talking about, which is like, what does the business do? Does it have a moat? Is there long-term potential? Those things are applied no matter size, scope, or anything.
Follow up, you can determine the stages using a prompt. And one thing that's really important is that a small cap stock can be in stage 5. They might just be playing in a smaller market. And so they could be fully mature at that size.
You can have $1 million in revenue and be in stage 6. Like the size of the company is irrelevant to the phase that you're in.
Last question. Does this work for REITs?
Not as well. They're in a specialty. They're in a specialty financial category. So again, the business works, the moat works, the growth sources work, the key metrics not as well, the risks work, and the valuation not as well. So on 80% of the companies, it works fine. On that remaining 20%, it gets you about 80% of the way there.
Yep. Just one more thing. Dora's pointing out that it's basically 2 businesses, retail and AWS. We're bundling them together. Again, Stock Simplifier. We're trying to simplify. You're not wrong, though. Like, if you want to take the time to break those apart, that's worth doing. And Jason's question is, hey, these metrics are stellar, and the stock's only up 1% year to date. What gives? What do you think?
Did you know you can AFK Bloods and Zaya whilst learning to code in Python? Go to boot.dev. We've known our students to pull it off. Here's how. Monitor 1, code. Monitor 2, level rune crafting. Before you know it, you'll have written thousands of lines of real code and even knocked out that Karamja Elite Diary rune crafting requirement. It's well known that developers make bank and work remotely, but only slightly less well known is that you'll never have to be bored while learning to code these days. No lengthy video lectures required. We won't tell you it'll be easy. It won't be, but it is fun. Even addicting if you love computers and puzzle solving. You won't be alone. Meet Boots, an expert computer scientist, accomplished wizard, and bear. He's an AI built with the most advanced models and trained specifically to gently nudge you and your code in the right direction instead of simply giving you the answers. We can't stand dark patterns and won't allow any student to pay for something they don't enjoy. All our courses are free to try, and if you don't like them for any reason, we'll give you your money back within 30 days. Bosses, bears, and boots await you, and a bright future as a developer. If you've got it in you, go to boot.dev and learn to code now.
What if employer-sponsored insurance didn't have to be group insurance? Group health plans often come with rising costs. And more importantly, healthcare isn't a group decision. It's personal. Even with the buying power of an entire business, group insurance can still mean high costs and limited choices. That puts businesses in a tough position and leaves employees with plan options that might not be the best fit for them. Or worse, no options at all. Now, a new form of employer coverage can help. ICHRAs offer the kind of control businesses and employees need. They make costs predictable, thanks to a much larger risk pool and stable employer contributions. They make plans personal, because employees can buy any plan that fits their needs from any carrier on the marketplace. And they make coverage possible, because ICHRAs means some businesses can now afford to offer insurance for the first time. So what exactly is an ICHRA? ICHRA stands for Individual Coverage Health Reimbursement Arrangements, and it means that businesses can
Well, let's take a look. When in doubt, you know what I always do?
Zoom out.
Zoom out. When in doubt, zoom out.
Right there. Yep, that's the right one.
Go. Okay.
So make
So
it
this
make it
is-
a percentage.
Yeah. So percent change. Okay. So this is year to date, 1%, 1 year, 18%, 3 years, 5 years. Oh, it's already up 40% of the last 5 years.
Well, and part of that's because where that 5 years starts.
Yeah. So the long term looks pretty good.
Yeah, well, go to where we bought it in 2010, 2011. So, I mean, why is it up so much or so little? I mean, trying to explain why a stock goes up or down over less than 3 years, it has more to do with emotions than anything else,
Yeah,
and valuation.
And
which
when
is our
did you
last
buy? And when did you buy it? So let's do from. Yeah. And why hasn't it performed better? Financials that look great and underperforming stock is a magical combination if you want
Yeah.
to buy it.
You should love to see that as an investor.
Yeah. If you're a seller, that should make you mad. If you're
Yeah.
a buyer, that should make you very happy.
Yep.
In fact,
So-
that's best case scenario if you're a buyer.
I'll also just throw out there, like all big companies, it's spending hand over fist on AI.
Sure. Yep. And COVID was a whipsaw. Like it pulled forward so much demand. The company way overspent, and then it had a Bezos headed for the exits, and I mean, all kinds of reasons why it's kind of underperformed over the last year or 3 years. But over the long term, there's more to like, and we're gonna get to valuation quite soon. All right. So next, risks. When we analyzed risks, and again, Stock Simplifier, we said that all risks boil down to one risk: execution risk. Can the company do everything that we just looked up promising it? Can the company execute on the growth that we think that it has? What are the chances of that happening? So there are 4 broad risks that prevent a company from executing. There's concentration risk, there's disruption risk, there's outside forces risk, and there's competition risk. So all of those combined together to come up with one mega risk. What do you think are the chances that this company won't be able to execute on its growth plan? So we do have a prompt for this, the key metrics prompts. Let's put that in there, and let's see what ChatGPT says about Amazon's execution risk. Okay. Overall risk, it says, is medium. Its primary risk factors are outside forces and competition.
I'm curious to see what outside forces it's calling on. Maybe just the economy in general.
Yep. And it might be, yeah, well, let's see. So key mitigations are, of course, its moat. So it's scale, it's diversified business, and continued innovation and automation. Okay. So concentration risk. This is not a problem, according to ChatGPT. No single customer exceeds 10% of sales, and it's hugely diversified. I would 100% agree with that. Disruption risk, it says, not a problem. Amazon is the primary disruptor in e-commerce and cloud computing, and it has lots of tools, risk factors in emerging AI competition, but no specific displacement threat.
Real quick on that, Brian, because we got a really humorous, someone said you were talking about the drone company perhaps being disruptive.
Yep.
And there was someone who worked with them in Texas and Amazon, and they said they weren't able to make it work because people were shooting them down over ranches. There you go.
Good to know. It's almost like people aren't used to that technology as of yet. Okay, next, outside forces, yellow, and this is a trending higher. So antitrust and regulatory scrutiny
makes total sense.
Outside forces, macro exposure to inflation, labor, energy prices, and exchange rates. And then AWS sensitivity to IT enterprise spending and interest rates could pressure growth if economic conditions tighten, and the trend is rising as regulatory environment intensifies. So, okay, it's saying that's a risk.
Yep.
Competition risk. This is a trend that's going higher. So, big pressure from Walmart, Temu, and Shein. AWS has competition from Azure and cloud, and I think that those are growing faster. Yeah, look at that.
Yeah, they are.
Azure is growing faster than AWS. So
they're
Azure,
smaller than AWS, so it's a smaller base, but they are growing faster.
their scale is meaningful. It's
Yes,
not
it
that
is.
much smaller.
Yeah.
Advertising revenue faces competition from Google, Meta, and TikTok. I would actually flip that around and say that Google, Meta, and TikTok have advertising revenue challenges from Amazon. And then margins improving is a problem. So no concentration, no disruption, moderate outside forces, moderate competition. Brian, let's throw a poll up. What do people think? What do you guys think of Amazon's execution risk? Would you rank this as a high risk situation, a medium risk situation, or a low risk situation?
If I died tomorrow, I would want all patients with memory lapses lasting more than 2 years to know this. Few people know this, but Alzheimer and dementia.
It is interesting to see the regulatory come up with what the last 48 hours have kind of brought to light. On the one hand, you could look at that AWS outage as evidence of just how important AWS is. On the other hand, you could say, man, if I was a legislator, I would be saying, we as a country have a lot of concentration risk that we need to mitigate.
And wasn't Amazon stock up yesterday?
It was.
Yeah.
It was. Now, I will say, too, the other thing a couple people talked about when we first started this is Amazon just announced today that they're looking to replace 600,000 employees over the next couple of years in their warehouses with robots. And if memory serves, that's equivalent to between a third and 40% of their employees. So that's,
I think they have
that's not
1.5 million
insignificant.
employees, something like that.
Yeah. All right. So
Actually,
I'm
I
ending the
think
poll.
they have that here. Doesn't they have that here?
66% of people gave it a yellow for risky, and 33% said green. We had almost no red, which is that's very interesting.
I would go if there was an option for greenish yellow, I would have chosen that. If forced to choose, I would say green. I would say it's a low risk bet personally. How about you?
I would go greenish yellow. There's a reason it's one of my biggest positions.
Yep. Friendly reminder, if you want Stock Simplifier, it's $99 with the link in the
there.
All right. So forward valuation. So we want forward price to earnings and we want forward price to free cash flow. All right. So, that's
one thing I noticed too is you're only looking at the last. For some reason, it's stuck on the last 5 years.
Here.
Yeah, up top.
It's actually got all of them, but.
Well, once you change that, it'll pop up.
Oh yeah, you're right.
Because sometimes it does that.
If I X that out. Okay, so here's all time, or at least 20 years. So let's get that out to the last 4. All right, we have this really ugly time here during COVID. You can see how like disruptive that is to like the valuation pattern. So unfortunately, we have to exclude this period here, which Amazon was losing money basically there. So we have to bring this slider over to the period that does not include that. So if we exclude that, we'll take them one at a time. So let's look at price to earnings first. Here's price to earnings.
So
Can you
32
see that
times
okay?
forward earnings.
Can you see that okay?
Yep, yep.
All right. So it's currently trading at 32 times forward earnings. And if we graph that out with that toggle and we do medium, high, and low, we see that the low for this period was 26 times earnings, and the high was obviously many times earnings. And if we kind of even exclude that, I'm gonna swing this to 2024, just because that's really normalized, if you will. So this is kind of the last year. So on a price to earnings, a forward basis, 32 times. It was as low as 26 and as high as 36. Okay.
No, one thing I would just point out real quick, Brian, especially when we do the free cash flow.
Yeah.
Because this is the median and not the mean, you can pull it back to include those wonky areas because it won't throw it off the same way that it would if it was a mean.
So if you were doing this, you'd look at it like this?
Yeah, I might even pull it back further and include those weird areas because, again, it's just the median. So the minimum, yeah, that gets crazy. The maximum gets crazy, but the median still at 41 seems somewhat reasonable.
This seems like a decent look.
Yeah.
Right. So, okay. So it says the average is 35 over the last 3 years, currently 32. Now that's forward price to earnings. So let's do that same analysis for price to free cash flow. Price to free cash flow. Okay. So we push this little graph line button here, mean, minimum, max. And we see that it was 108 times free cash flow, as low as 19 times free cash flow. So this to me really reflects we got to spend like crazy on these data centers, which is really compressing free cash flow.
And I know that we normally we stop at that, but just to show you how we can take it to the next level, I think looking at operating cash flow is more instructive because I don't think, and Brian, tell me what you think, but I don't believe they're going to be spending $100 billion per year forever on AI. Maybe I'm wrong, but I think that they're not going to be doing that.
Well, I think that price to operating cash flow has historically been a better measure of value. So let's get on the same stage about what this means. Operating cash flow is how much cash the business throws off, but does not subtract capital expenditures. So it does not include building out fulfillment centers, does not include building out on AI and data centers.
Blackwell chips.
Right. It excludes that. Free cash flow includes that. Operating cash flow excludes that.
Yeah.
So this is just how much cash flow is the business producing. And if you use this metric, it can help to normalize heavy spenders like Amazon. So I think we should be able to.
I think you can really pull that one back.
Yeah.
So
if we look at that one, what's this? I'm gonna do 10 years or
sure.
Yeah, all right. That's not terrible. So medium, mid, and high. So Amazon historically traded at 35 times operating cash flow at the peak and 9 times operating cash flow at the low. Currently 15 times operating cash flow with a median of 18 times operating cash flow. So, all right, we just threw a bunch of metrics at you. What do you think of Amazon's valuation today? Green, it's undervalued. Yellow, it's fairly valued. Red, it's overvalued.
This credit card has an interest rate that's really, really low. How low? This low. The credit card that's in your wallet.
I know what my answer would be.
Yep.
Look at that. And we're coming up on 30 seconds and 2/3 of people have voted. So I'm gonna end the poll and share because basically 2/3 of people said that it is yellow, fairly valued.
Yep.
And 1/3 said it is green, undervalued. Any thoughts on that, Brian?
So if I was forced to choose, I would also say yellow, and I would say yellow with a tinge of green. Personally, I would have no problem buying this stock at the valuation today, given that I personally think that the execution risk is fairly low, but I don't think this is like no-brainer, unbelievably undervalued territory.
Right. I was adding to it aggressively when it was in the 180s and 170s, and it's up in, I believe, like the 220s now. So to me, it's much more yellow. But it's also one of my largest positions because I like being able to look down and say, I don't think that there's as much downside risk.
All right, last one. Are you interested in this stock? What do you think of Amazon today, given everything that we just covered over the last hour? Do you think this is a buy? Do you think this is a hold? Do you think this is a sell?
I am just looking for an "Are you interested?" question. I think we might not have gotten that one.
Oh,
let's see.
okay.
Here, I've got it. There we go.
Great.
So for "Are you interested?" let's say red is buy, yellow is hold, green. Sorry, red is sell, yellow is hold, green is buy. I like Bruce. I think it will be bigger in 10 years. And Richard asks, what metric do we use for phase 4? There's a couple of different metrics we use, but if you want a true kind of shortcut is look at operating profits. That's the biggest one.
So here's the general thing that we go with, again, Stock Simplifier. When we made Stock Simplifier, we forced ourselves to simplify everything. We think it's a great first pass. We really think it's a fantastic first pass. There's nuance, right? So Amazon has historically been extremely hard to value. So for Amazon, price to operating cash flow is probably the best metric to use. Yeah.
So we've got basically a 50-50 split. 53% say buy, 46% say hold.
Awesome. And again, I own this stock. Stoffel owns this stock. It's done fabulously well for me over the long term. It's been disappointing over the last 3 years, 5 years.
To me, that's fine.
Yeah, exactly. It's been an underperformer more recently, but that's just how stocks go. So we have any questions, Brian, that we can we have a couple minutes here, so let's knock out some questions.
Let's see. One question: what is your take on Amazon versus Mercado Libre in Latin America?
Well, Mercado Libre is my number one holding. So I've seen this story before of fill in the blank competitor tries to enter Mercado Libre's territory and take them on. Amazon is a major competitor. They should not be trifled with, but no reason you can't own both.
Yeah, and I'll also just say, this goes back to what I believe the key mode is, that logistics, their fulfillment network. That takes a long time and a lot of money to replicate, and Mercado Libre has already started doing that in Latin America. They're ahead of Amazon in that respect. So,
by the way, would anybody like us to do this analysis on Mercado Libre? We'd be happy to in a future episode.
Yep. So, how about this? What are we? Buy, sell, or hold? What are you at?
So I've been holding it for 15 years. I am not in a rush to add to my position. If I did not own Amazon, I would happily buy it today, fresh. But since it's already a meaningful holding for me, I am personally not going to buy it. But you mentioned, Brian, you were adding to it fairly recently, right?
When it was in the 180s, I was.
Yeah. So current price is $220. So would you consider this stock a strong buy in the 180s?
No, well, in the 180s, yes. So what I would say, so here's the way that I think about it. Right now, it switches every day between my second and third largest position. If I'm not selling it, then one way to look at it is to say it's a buy. Because if you really want to be a great investor, every morning you wake up, you should be like, am I comfortable with this being 10% of my portfolio? My answer is yes, so it's a buy. At the same time, I'm not adding to it because it's already 10% of my portfolio. So you could say, oh, well, then it's a hold.
Yep.
6 of one, a half dozen of another.
Yeah. How about this? Do you think this company's going to beat the market over the next 5 years?
I think it's going to beat it over the next 10 years.
Okay.
I'll say that.
I think it's going to beat it over the next 5.
Mm-hmm.
Yeah.
Great. Let's see. What types of companies or sectors would you not use Stock Simplifier for? You mentioned a couple. Are there any others?
Stop. Don't get a HELOC until you know about HEI. HELOCs are loans. You borrow, pay interest, and make monthly payments.
is pretty much your Bitcoin miner turned into a PowerShell